Alright friends, so very good morning. Today we are about to discuss May 2024 past exam question paper. So what we are doing is, we will be discussing all the descriptive questions that asked in May 2024. So I want all of you to go through the question number 1. This is the first descriptive question that they've asked in May 2024. This question carries around what is the mark weightage of this question? Let's check. It contains 14 marks. Okay, it contains 14 marks. It's basically a head of income question, but majority of the adjustments are from PGBP only. So it's predominantly a PGBP question with the adjustments from other heads as well. So I want all of you to go through this question first, and once you read the question, we'll be doing it together. Okay, so take 5 to 6 minutes time, go through this question, understand this question, then we will do it together. Okay friends, so I hope you have gone through the question. Now we will solve it together. So I want all of you to be very attentive right now, because we will read each and every adjustment, and we will, including working notes, I will tell you. Okay, whenever we are discussing a particular adjustment, I will definitely explain the relevant theory as well, so that it will be easy for you to understand the concept. So starting with the question, Orion Pharmaceuticals Private Limited is an Indian company engaged in the business of manufacturing and providing access to affordable and innovative medicines and healthcare solutions. So they are doing some medicine and healthcare solutions. The company is incorporated in the year 2009, and the company shows a net profit of 95 lakhs as per the statement of P&L account. So the net profit of the company is 95 lakhs as per the P&L account, ended with 31st March 2024. So in examination, what we need to do is, if such a question, if they are asking an examination, you need to write it in a proper format. So computation of total income for 2023-24 PY or 2024-25 AY. And the format which I normally recommend is this: particulars, amount. Alright, so we will write first PGBP. PGBP. In exam, you have to write it in full. Profits or gains from business or profession, you can write it in full for your exams. So listen. Alright, so moving on to the first adjustment, we will write the net profit first. Net profit as per P&L account. How much is the net profit as per P&L account? 95 lakhs. Then, what is the next one? The amount of depreciation as per the Companies Act claimed in the statement of P&L account is 11 lakh 90,000. So depreciation as per Companies Act, what to do? Add back. What else to do? Companies Act depreciation, you have to completely add back. So we can write depreciation as per books of accounts. How much is the depreciation as per books of accounts? 11 lakh 90,000. Then, what is the second adjustment? The amount of employee benefit includes a sum of 13 lakh in respect of bonus payable to the employees. In the previous year 23-24, the company and its employee union had a dispute over the payment of bonus. In order to avoid late payment of bonus, the company formed a trust and transferred the amount of bonus payable to employees to the said trust. The dispute was settled in the month of August 2024, and the trust paid the amount of bonus to the employees as on 31st August 2024. So let's understand what exactly happened in this case. Okay, so listen, for a better understanding, I'll draw a picture. So what I want to say is, say for example, you are the company, you are supposed to pay bonus to the employees, but the employee and the company had a dispute. So even though you offered bonus, the employees was not accepting that particular bonus. Okay, you offered bonus, but the employees were not accepting that particular bonus. So what you did is, like, you paid that bonus to a trust. You formed a trust. And transferred that particular bonus to that particular trust. Okay, now thereafter, once the dispute got over, the trust paid that amount to the employees. Okay, once the dispute got over, the trust paid the employees, bonus to the employees. Now, the payment of bonus from the trust to the employee happened in the date August 2024. The relevant PY was 2023-24. So there are two sections. First of all, section 43B. What is section 43B says? Bonus, if payable by the employer to the employee, you have to actually make the payment before due date of filing your return to claim it as a deduction. So according to 43B, we have to check whether it is paid before due date. So since it is a company, for 23-24, return filing due date will be 31st October 2024. So the bonus have been ultimately paid to the employees before 31st October 2024. That is fine. There won't be any disallowance in 43B. But there is another problem, that is section 40A9. What 40A9 says is, if you are an employer and you are paying any employee benefit to any trust, company, etc., shall be fully disallowed. You are an employer and you are paying any employee benefit to any company, trust, etc., that full payment shall be fully disallowed. So here what we can say is, the company initially paid the bonus to a trust. Instead of directly paying it to the employee, the company paid that bonus to a particular trust. So there can be a disallowance under section 40A9. But this is actually a case law. Okay, so I'll show the case law. So this is the page number 55 in our handbook. That is Shawson Chemicals and Drugs Limited 2016 Supreme Court. Okay, if you have the handbook, you take page number 55, it is there. In case where payment of bonus due to the employees is paid to a trust and such amount is subsequently paid to the employee before the due date of filing return of that year, would the same be allowed as deduction under 36 while computing business income? Now, what is the conclusion? The restriction for deduction under 43B or 40A9 does not apply here, since the bonus was ultimately paid to the employees before due date of filing, before due date. Therefore, payment in respect of bonus is allowable as deduction. So both 43B and 40A9 will not come into the picture, because according to the Supreme Court, since the employer was he don't have any other option. Okay, because the employees were not accepting the bonus since they had a dispute. So the employer was actually forced to make the payment to a trust, and thereafter ultimately the payment have been gone from the trust to the employee. So ultimately, if you check the substance over form principle, the payment have been gone from the employer to the employee through a trust, that to honor before due date of filing return. So Supreme Court say both 43B and 40A9 disallowance will not be applicable, and you can claim a deduction for that. Now coming back to the question, so the amount of employee benefit includes 13 lakh. So these items are either debited or credited. So this 13 lakh have been already debited to the statement of P&L account, and it is allowable as a deduction also, and hence you don't have to do any further adjustment. The only thing that you have to write is a note. Okay, so I'll show you how to write a note for this. You have to write bonus to employees. Bonus to employees. And what should be your note? Bonus to employees, and you can write nil. No adjustment required. Why? Since it is actually paid by employer to employee before due date of filing return, and same has been debited to P&L account. If you write this much, you will get the respective mark for that particular adjustment. If you don't write note, then what will happen? If you don't write note, then as you all know, you will lose marks in examination. You have to write the notes. Okay, if you simply skip this, then the assumption taken by the institute will be you haven't read that particular adjustment. You have completely skipped it. You have to write the note and you have to write nil. Okay, for getting marks. This is mandatory. Moving on to the next adjustment. What is the next adjustment? Item number 3. What is 3? An amount paid by the company as regularization fee for violating law prescribed by Medical Council of India of manufacturing medicines, 9,50,000. So, a company paid regularization fee for violating law. You are violating a law which is prescribed by Medical Council of India. But there is a problem. This Medical Council of India is not an act. It's not a statutory body. It's an association of medical practitioners in India. Okay. So you have paid some fees to the IMA, Indian Medical Association. All right. Is that a penalty for violating a law or an act? No. It is not a penalty for violating any act. But there is one twist. What is that twist? If you go check section 37, there is an explanation inserted by the Income Tax Department. If you go check section 37, you can see an explanation inserted by the Income Tax Department, and this is the explanation. It is there in page number 42 of our handbook. Okay, and this is the explanation. Listen, friends, you are making any payment. Any offense prohibited by law would include expenditure incurred by a person for any purpose which is violation of law or rule or regulation or guideline governing the conduct of such recipient. That simply means if the payment given by you is for violation of any bylaw. Okay, the payment given by you is violation of any bylaw, then also you will not get that payment as a deduction. Any payments given by you is for violation of any law, rule, regulation, guideline governing the conduct of recipient. That means any say for example, whether it is a legal violation or any bylaw of an official association in India, that also shall be fully disallowed under section 37. Are you all with me? And hence, since the payment, even though it is called as a regularization fee, it is actually paid for violating some guidelines provided by IMA. And hence, that also was not allowed as a deduction. That also have to be fully disallowed. So, regularization fee. You have to write the note. Okay, I'm not writing every note. Okay, you have to write the note. It is a what do you say? This payment is given for violation of a bylaw by IMA, and hence it is not allowed as a deduction under section 37. And you have to write. You have to add back that respective amount. And how much is that respective amount, friends? 9,50,000. I hope you can manage the note. Okay, so the regularization fee is not allowable as deduction. So moving on to the next adjustment, friends. What is the next item? Listen, item number 4. An amount of 45,000 was paid as late fee to the government for company's failure in performance of contract with stipulated time. So it is just like a late fee to the government. Okay, but that is not for a violation of any act. It is a contractual payment. That means you had some contract with the government, maybe to supply some medicines or something. Okay, you are not able to fulfill that particular contract on time. So according to the contract, you are supposed to pay some extra amount that is called as late fee according to that respective contract. So there was a delay of 5 months, and according to the agreement, the company have to pay a late fees of 9,000 per month to the government. So listen, this is not for the violation of any act. This is not for the violation of any bylaw. You and the government have made a contract. Based on the contract, you are supposed to make some payment to the government on time. Not payment, you are supposed to supply something to the government on time. You are not able to do that. It's called as contractual penalties. Contractual penalties are fully allowed as a deduction. There is absolutely no problem. Are you all with me? Again, you can refer under 37. I have given expenses allowable under 37. Under that list, you can see, say, contractual penalty, that is amount paid or payable in respect of breach of contract, is definitely allowable as deduction under section 37. So what you can do is you can claim it as a deduction. It is already debited to the statement of P&L account, and you have to write a note. That is more than enough. And what should be the note? It is a contractual penalty given to the government and allowed as a deduction. Since it is already paid to the statement of P&L account, you are not supposed to do any further adjustment. So contractual penalty, you have to write nil. Why? Because already adjusted to the statement of P&L account. Then, what is the next item? So, moving on to the next item, friends, that is item number 5. The company earned a profit of 7,50,000 on sale of plot of land on 25th August 2023 to Sudhagar Private Limited, a domestic company, entire shares of which are held by the assessee company. So, assessee company, that means what is the name of our company? Orient Pharmaceuticals. So, this Orient Pharmaceutical is the parent company of Sudhagar. And Orient Pharmaceutical holds 100% shares of Sudhagar. And you sold something to your 100% subsidiary company for a profit of 7,50,000. The plot was acquired by Orient Pharmaceuticals Limited on 20th 12 2022. This profit is included in the income of the assessee company. So, for this you have to refer capital gains. So, let's take capital gains. So, friends, page number 210 in capital gains, section 47. What is section 47? Transactions not regarded as transfer. So, the speciality is normally when there is a transfer of capital asset, you have to compute capital gain. But there is a section called section 47, and what section 47 says is whatever items covered under section 47 is not regarded as a transfer, and hence you don't have to compute capital gains in the following situations. Out of that, item number 3, you can read any transfer by parent company to its subsidiary company or vice versa. What is that? If you are a parent company and you are transferring some capital assets to your subsidiary company, and if that subsidiary company should be provided, the parent company on its nominee must hold 100% of the shares of subsidiary company. That means the parent have to be a 100% parent company. That means the parent have to hold all the shares of subsidiary company. If the parent is holding all the shares of subsidiary company, then transfer of capital asset from parent to subsidiary is not regarded as transfer. So, when it comes to this question, first of all, you have considered or credited that book profit in your P&L account. You need to remove it, less it from the book profit. You don't need to add anything in capital gain because this is not regarded as transfer. So, the adjustment that you are supposed to do is book profit on sale of land to 100% subsidiary company. How much is the amount? 7,50,000. So that 7,50,000 have to be deducted from the profit, and you have to write a note. It is not dealt under capital gain. Why? Because it's a transfer happened between 100% holding company and subsidiary company. Under section 47, it is not regarded as transfer. So you don't need to compute capital gain. This should be your answer. This has to be written in your answer sheet. Otherwise, you will lose your marks. Great. Moving on to the next adjustment, friends. What is the next adjustment? Adjustment number 6. The company earned a profit of 4,50,000 on sale of 2,500 shares of Messrs. Steady Limited, whatever it is, some limited company, a listed Indian company. These shares were sold on 8/11/2023 for 280 per share. The highest trading price of that particular company as on stock exchange was 175 per share, and the lowest trading price quoted on stock exchange was 165 per share. The shares were acquired for 100 per share on 11/7/2016. STD paid both at the time of purchase and sale of shares. So, as you all know, this is an item that have to be dealt under capital gains, which will come under section 112A. So, what you need to do? First of all, you need to remove the profit from the net profit, from the PGBP profit, and you have to consider it under capital gains. So, what we can do is, we can write a note, profit on sale of listed share. How much is the profit on sale of listed share, friends? They are showing the profit of 4,50,000. So that you have to remove from here. Don't add this 4,50,000 to the capital gain because you have to compute the capital gains. Now moving on to the capital gains, I'll leave some space over here and I will write capital gains in the next page. So capital gains. So capital gains, the first figure that you require is full value consideration. So you tell me how much is the full value consideration. So the full value consideration, we can find it from the question itself. Sold for 280 per share. So 280 into how many shares are there? 2,500 shares are there. 2,500 shares. So how much will be the total full value consideration? 280 into 2,500, it will be 7 lakhs. Exactly 7 lakh is the full value consideration. And as you all know, there is no direct expenses in the on transfer in the question. So we'll directly jump to cost of acquisition. So while computing cost of acquisition, there are certain speciality. Since it is a listed share and the purchase of this share happened in 2016, that means before 31st January 2018. What is the speciality if the share is purchased before 31st January 2018? When you are purchasing a share before 31st January 2018, there are certain specialities in capital gain. So let's refer that particular note in capital gain. What they are saying is, when you compute these kinds of cost of acquisition, first you have to take either the original cost of acquisition or lower of full value consideration or fair market value as on 31st January 2018. So this is the formula for computing the cost of acquisition. Let's see. The cost of acquisition of assets purchased on or before 31st January 2018. If you are purchasing an asset on or before 31st January 2018, how do you compute the cost? Either you take the actual cost of acquisition. In this question, how much is the actual cost of acquisition, friends? This question, actual cost of acquisition is 100 per share. Yes or no? So actual cost of acquisition is 100 rupees per share. Now, lower of fair market value as on 31st January 2018. What is 31st January 2018's fair market value? Actually, they have given two price, highest price and lowest price in the question. Yes or no? They have given the highest price, that is 175, and the lowest price, that is 165. Which one you should pick? Let's see. For that, determination of fair market value as on 31st January 2018 is given in the handbook page number 218. And what is the fair market value? If above assets are listed of recognized stock exchange, listed on recognized stock exchange as on 31st January 2018, then fair market value shall be the highest price quoted on 31st January 2018. So which is the highest price quoted on 31st January 2018? 175. Okay. Now, or full value consideration. What is full value consideration? The amount that you got at the time of sale, that was 280 per share. So you compare these two and pick the lower. Which is lower? 175. And you can compare this 175 and the actual cost 100, and you can pick whichever you want. That's why they are not saying anything. Whichever is beneficial for you. You tell me which is more beneficial. The higher will be more beneficial. And which is higher? 175. So that is the beneficial amount, and you can take that 175 itself as the cost of acquisition. So 175 into 2,500 shares. Now, can you claim the benefit of indexation? No, you cannot claim the benefit of indexation. So 175 into 2,500, and can you help me with the math? How much will be 175 into 2,500? Come again? 4,37,500. So if you deduct this cost of acquisition, how much will be the total long-term capital gain? 2,62,500. Again, don't deduct 1 lakh, because 112A says while computing rate of tax only, you are supposed to take the benefit of 1 lakh. Hope you remember 112A. What is 112A? The capital gain over and above 1 lakh only shall be taxed at 10% rate of tax. Here, when you compute the total capital gain, you have to write it in full. When you compute the tax liability only, you are supposed to deduct that rupees 1 lakh. Got it. Moving on to the next one, item number 7. Bank guarantee was given by the company towards disputed tax liabilities. So listen, this adjustment is, in a way, it is a little bit vague. Why it's vague actually? See, we don't know what type of tax liability it is. They are only saying tax liability. Okay. We don't know whether it is income tax liability, or we don't know whether it is GST liability. We don't know whether it is customs liability. That concern is obviously there. Now, first of all, if it is income tax liability, fully disallowed, because income tax, its surcharge, cess, whatever it is never allowed as deduction. What if it is GST or customs, something like that? If it is GST or customs, then you have to actually make the payment according to 43B. Furnishing a bank guarantee is not regarded as an actual payment. You have to actually make the payment to claim it as a deduction. Section 43B. So this way, in this case, I am assuming that it is not income tax. It is some other taxes. This is what the assumption is. So I have to write the assumption also. What is the bank guarantee towards disputed tax liability? So, disputed tax liability assumption. What is the assumption? It is not income tax liability. Then under section 43B, furnishing bank guarantee not treated as actual payment, hence disallowed. So in this way, please never mug up income tax, never buy hurt income tax, because in such scenario, what will you do? First of all, you should understand what exactly is the concept. So conceptual clarity is a very important thing in understanding and learning income tax. So first of all, you should understand what is the scenario, what should be the possibility, what all are the possibilities. Always you think in this analytical manner. What if it is income tax? This will be like this. What if it is some other tax? This will be like this. Always do that kind of analytical thing. Okay. So here I am disallowing that entire amount. That is 11 lakh. You know the reason. It's not minus. You have to add it back. Okay. Hope you understood what I said. Moving on to the next adjustment, friends. What is the next adjustment? Company debited an interest of 7,50,000, which the company remitted as interest to a company incorporated in USA on loan taken 3 years ago. Tax deducted under 195 from such interest has been deducted in March 2024, but deposited by the company on 14th July 2024. So listen. So you are a company and you are making some interest payment to a US company. Okay. So we will write a note for this for a better understanding. Say assessee company made a payment of interest to a US company. Okay, the interest debited on March 2024. What they are saying is you actually paid the interest, the company debited the interest of 7,50,000, which company remitted as an interest to a company incorporated in USA on a loan taken 3 years ago. Tax deducted source under 195 from such interest has been deducted in March 2023. So you debited, it is in the year 23-24. Okay, we will write 23-24, and TDS has been deducted in March 2024. And actual you have debited, you have deducted the TDS in March 2024 and made the payment to the credit of central government on when? On July 2024 you have actually made the payment. On 14th July 2024 you have actually made the payment to the credit of central government. So when you check section 40A1, section 40A1, two things have to be there. Number one, TDS deduction. Deduction have to happen in the PY, in the respective PY itself. That means in 23-24 itself. If you have deducted TDS in 23-24 and made the payment to the credit of central government on or before filing your return, on or before due date of filing your return, then there is no disallowance. So here they have deducted in 23-24, made the payment on or before due date of filing return, because since it is a company, its due date of filing return will be anyways on 31st October 2024. And hence, what should be the adjustment? No adjustment required. It is fully deductible and you have already debited to the statement of P&L account, and hence no further adjustment required. What you can write is, when you write note in exam, how to write this? Let's see. Since TDS deducted in relevant PY and made payment on or before due date of filing return, it is allowed as deduction under section 40A1. It is not a disallowance that you have to write. Rather than deduction, you have to write it is not a disallowance. So that interest element is fully allowed as deduction, and you can write nil. Why? Because it is already debited to a statement of P&L account and you don't have to deduct it again. I hope you got my point. Again, moving on with the next one. Item number 9. The company has contributed 65,000 to an electoral trust by an account paid check and the same is debited to the statement of P&L account. Any donation to an electoral trust is allowable as a deduction under section 80GGB for company SCs. Only one condition is there. The donation have to happen in any mode other than cash. Cash donations are not allowable as a deduction under 80GGB. So what you can do is, this is not allowable as a deduction while computing the PGBP income. You can claim it from the GTI, gross total income, under chapter 6A. So you need to add back it from the net profit. So donation to electoral trust. In exam, you have to write electoral trust, okay. I have written ET, okay. It can be called as extraterrestrial also. So don't write ET and all, you have to write it in full in exams. So donation to ET, how much is that? 65,000 have to be added back over here. And right now itself, you have to leave some space and write chapter 6A deduction. In examination, you have to mandatorily write this. Otherwise, you will forget. So leave some spaces everywhere. Okay, leave some vacant spaces in between. No problem. There's absolutely no problem. You will not lose any marks if you leave some vacant spaces in between. Okay, leave some spaces and write amount donated to electoral trust 65,000 is allowable as deduction under section 80GGB. Moving on to the next item. So we have done with all the first set of items. Now we have some additional adjustments to deal with. Let's read and understand each and every additional adjustments in a detailed manner. Following additional information is provided by the company in the previous year 23-24. They have given certain additional adjustments and let's deal with the additional adjustments as well. Number 1. Closing stock includes 1,200 pieces of imported machinery spares at its landed cost on the date of import at $25 per piece. The exchange rate on the date of import was $1 equal to 82.88 round off. Exchange rate as on 31st March 24. That means the last day of the PY was $1 equal to 83 rupees. Market value per piece as on 31st March 2024 was $27 per piece. First of all, if such an adjustment is there in the question, you need to understand what exactly is that. Listen, they are saying closing stock include 1,200 pieces of imported machinery spare. So what is the item? They are saying imported machinery spare. So listen friends, we will write machinery spare or we will write it here, okay? Machinery spare. What is the treatment of machinery spare in income tax? You can divide it into two. If it's a substantial part of machinery, then you have to capitalize it according to ICDS 5. According to ICDS 5, that is fixed assets, if machinery spare is a substantial spare. What is substantial spare? A spare which improves life, usage, volume, capacity, etc. of a machinery. Say for example, I'm using a car for my business. Okay, I'm changing the engine for more performance. That engine can be called as a substantial replacement. Okay, I'm changing the tire or changing the brake pad. That is a normal wear and tear spare. So the second part is, if it is not a substantial part, so if it is a normal spare part, then you can consider it as either consumable or a raw material and it should form part of the closing stock. And according to ICDS 2, you have to evaluate either cost or net realizable value, whichever is lower. So these are the possibilities. So the moral of the story is you should learn ICDS as well. That is the simple moral of the story. So this is the treatment of a machinery spare. But in this question, it is a little bit vague. We don't know whether it is a substantial part of machinery or whether it is a easily replaceable raw material. That we don't know. So you have to take a stand. You have to take an assumption. Either you can assume it as a substantial part of machinery, or you can assume otherwise, because institute in the suggested answer list, they have given an alternative answers. Either you can stick on with this or stick on with the other one. So anyways, anything is fine. For the time being, I have to take one opinion, right? So I am considering it as a substantial part of machinery. I am considering it as a substantial part of machinery. You can consider otherwise also, that is also perfectly fine. So if I am assuming it as a substantial part of machinery, then now you tell me what should be the treatment. First of all, that machinery spare have to be removed from its actual cost. Okay. It have to be removed from the closing stock value. So listen. So you have to remove it from the closing stock. Now listen, in the question, when you coming back to this question, it's a little bit tricky. Okay, listen. Say, when you draft a P&L, so whoever drafted this P&L account, you have to be very careful, otherwise you will go wrong, okay? Whoever drafted this P&L account have shown this machinery spare as what? A part of closing stock. Are you with me? And what is the value of the closing stock? Say $25. $25 per piece. So it will be there as a part of the closing stock. Then he might have done one more thing. He would have included that in the purchases also. $25. When you prepare P&L account, you have to purchase the raw material. That purchase will come in the debit side. Yes or no? And that particular closing stock value, if it is not sold or not used, the value of closing stock will come on the credit side. So ultimately, if we are treating it, this treatment is actually wrong as per the books of accounts. Are you all with me? This treatment is actually wrong as per the books of accounts. So what you need to do? You need to remove it from both the purchases as well as from the closing stock. So to remove closing stock, you need to less that $25. To remove from purchases, you need to add back that $25. And hence you don't need to do any adjustment in the main computation sheet. Are you with me? Otherwise, you have to add back $25 and you have to deduct $25. There is no use of it. Are you all with me? Don't confuse it, because when you draft a P&L account, first of all, it will form part of the purchase. Right now, the assumption that we are taking that it should form part of the actual cost. That means it have to be capitalized. So it should not come in the P&L account. If you remove it from the P&L account, you need to add back $25 and you need to deduct $25. So the effect will get nullified. So what you can write is, you can write a note like this: machine spares, machinery spare, nil. Why I am writing nil? See, assumption or assuming that it form part of capital asset. So it should be adjusted from both purchases and closing stock, and hence no adjustment required. Or you can write, you have to add back 25 into how many dollars, how many pieces are there? 1200 pieces into that currency conversion. You have to add back that figure and you have to less that particular figure. You have to do it twice. Are you with me? So instead of doing that, I am writing nil, no adjustment required. Or you can write add back and less, that is also fine, but don't waste your time. Okay, don't waste your time. The note is more than sufficient for that. Are you all with me? Online. So that is the point. We haven't done anything in relation to this, but there is one thing. You have to write a note. Again, we are writing a note. Computation of depreciation. Computation of depreciation. How much is the value of the spare, friends? What is the value of that particular spare? We will take the value of that particular spare. Listen, for valuing it, how many spare were there? 1200 piece into what was the original transaction import value? That is $25. Since it's a monetary item, you can consider the currency conversion rate as on date of purchase itself. Okay, into 82.5 what was the conversion rate as on date of purchase? It was 82.88. So you can take that 82.88 itself. 82.88 rupee per dollar. Can you help me with the math? How much will be the amount? 24 lakh 86,400 into, you are considering it as a substantial part of machine. So you have to claim depreciation for that. Are you with me? Into 15%. So when was the import? The import happened on which day? The import happened on 15th September. So more than 180 days. And hence you can claim what? Full amount of depreciation. Okay, it's happened on 15th September. So more than 180 days and hence you can claim full 15%. How much is that figure? Can you help me with the math? 3,72,960 bus. Let it be here because you have to compute the other depreciations as well in the question. So whenever you comes up with a particular adjustment, you have to do everything in relation to that adjustment. Otherwise in exam stress, you will forget the other adjustments. Okay, so whenever you come up with an adjustment, you have to do everything in relation to that. Otherwise, when the exam stress mounts up, you will definitely forget the other things. So moving on to the next one. Moving on to the second additional adjustment, friends. What is that? Depreciation charged in the statement of P&L of 11.90 lakh includes depreciation calculated on the following assets. So they want us to compute the entire depreciation. They have given the information. It includes an amount of depreciation of 95,000 in respect of firefighting equipment installed in office premises and factories of the assessee during the year. There was no incidence of fire and hence the equipments were not used. Okay, were not used. So tell me, firefighting equipments. You might have seen this firefighting equipments in most of the offices. And most of the offices are not utilizing that firefighting equipments every year because there have to be a fire breakout to use that particular machinery. Under depreciation, there is a thing, hope you remember. This is that particular note. And what is that note? Usage can be passive as well. An asset can be said to be in use even when it is kept ready for use. That is, usage means passive as well as active usage. An asset, if it is kept ready for use, it is considered as actually used. Put to use includes active as well as passive use. So you have installed that particular firefighting equipment in your office. More than enough. It is not necessary that you have to turn it on, and hence you can definitely claim what? Depreciation on that particular asset as well. I hope you understood my point. You have to write this note in exam. It includes passive use also, and hence it is definitely assessee can claim depreciation on that particular asset. Then a new machinery which was installed and put to use on 15th May 2023 valuing 75 lakhs. So there is a machinery 75 lakhs. That is the value. That is a new machinery. That's what they are saying. So we'll go to the depreciation computation. So firefighting equipments, they have already computed the depreciation. Okay. So firefighting equipments, they have already computed the depreciation, that is 95,000. And again, we are taking an assumption. They have claimed the depreciation as per the rate provided under section 32. Because we don't know what exactly is the rate that they have computed. So we are assuming that this 95,000 is as per Income Tax Act only, since there is no other information available. Now, there is a new plant and machinery purchased and installed in May 2023. And what is the value of that new plant and machinery, friends? We've read it just now. The value is 75 lakhs. That is not depreciation, that is the value. So 75 lakhs, you are eligible to claim what? Depreciation. So 75 lakhs into 15%. How much is 15% of 75 lakhs? 9 lakh, 11 lakh 25,000. So it is 11 lakh 25,000. Not yet over. You can claim additional depreciation also because you are manufacturer of pharmaceutical. You are a manufacturer of medicine. Okay. And hence definitely you can claim additional depreciation as well. And how much is the additional depreciation? 75 lakhs into 20%. And how much is 20% on 75 lakhs? 15 lakhs. Now, that's it. Now moving on to the next one. And there is one more thing. One more thing is there, friends. Since he is a manufacturer, he can claim additional depreciation on that imported machinery spare also. Okay, since he is a manufacturer, he can claim additional depreciation on the imported spare also, that I forgot to claim earlier. So we will consider that also. So additional depreciation for that imported machinery spare. Do you remember? We have already computed normal depreciation for that spare. We have to compute additional depreciation as well. So additional depreciation is 24,86,400 into 20%. How much is the 20% of this value, friends? Can you help me with the math? 4,97,280. Great. Moving on to the adjustment. So there is a machinery which was sold to domestic company in 2016 as its WDV for 35 lakhs was acquired on 5th July 2023 for 65 lakhs. Which is this? Transfer of machinery from the holding company to the 100% subsidiary company. That is not at all regarded as transfer. Are you with me? That is not at all regarded as transfer. Hence, you can ignore this particular adjustment. Since it is not regarded as transfer, no capital gain adjustment required. Okay. That you can write as a footnote after the computation. After the computation, you can write a footnote. The machinery sold to the domestic company. Do you remember the domestic company was our 100% subsidiary company? Okay. For the domestic company, when you have sold that, in 2016, a machinery was sold to a domestic company in 2016 at its WDV for 35 lakhs was acquired on July 5th, 2023 for 65 lakhs. So you can simply ignore that because that doesn't lead to any adjustment because that domestic company is our 100% subsidiary company and we don't have to compute any capital gain for that. Moving on. There is no other fixed asset included in the company's accountant for calculation of depreciation except above these three assets mentioned above. Okay. So there are no other additional information given in the question. So we can compute the depreciation. Can you total the depreciation? Both the original and additional depreciation, how much is the total? $35,90,240 total depreciation that you can bring to the main computation. Okay, so depreciation working note number 1. Can you help me with the figure again? 35,90,240, right? That you can deduct. Yes. To the main sheet, okay. Now, is there anything pending? You are required to compute the total income of the company as per Income Tax Act 1961 for assessment year 24-25, indicating the reasons for treatment of each item, assuming that the company has not opted for special provisions under BAA or BAB. Done. This is it. So let's write the first. Let's compute the PGBP income. So friends, please help me in computing the PGBP income. How much is the PGBP income? Profits or gains from business or profession. Can you help me? How much is the PGBP income coming? See friends, again let me give you one more insight. Listen. See, when you go back to the domestic company adjustment, this adjustment. Listen. Come back to this adjustment again. A machinery which was sold to domestic company. Okay. There should be a comma. In 2016 at its WDV for 35 lakhs was reacquired on 5th July 2023 for 65 lakhs. Okay. So listen. See in the question, what they are saying is, point number 5. This is the one, right? The company earned a profit of 7,50,000 on sale of plot of land. Oh, not this. I think it is something else, right? Okay, this and that is actually different. Okay. There is a small error in what we have done. 1 second. So friends, listen, there is a small correction. See, I mistakenly thought that this is plant and machinery. Instead of plot of land, I thought it is plant and machinery. Okay, I'm really sorry. So we have to do adjustment in this also. This is also required to be adjusted. Listen. I thought when they use the word domestic company and machinery, I thought the other one was also machinery. The other one was plot of land. So it required to be adjusted. Listen, let's do this also. Okay, a machinery which was sold to a domestic company in 2016 as its WDV for 35 lakhs was reacquired on 5th July 2023 for 65 lakhs. So listen, I'll tell you what exactly is that. So they had a plant and machinery. That plant and machinery have been sold to, or we will write it here, okay? So listen. So we will write it over here. The company had a plant and machinery which is acquired in 2016. They sold it. Okay. In 2016, when they sold it, the WDV was how much? The WDV in the question, what they are saying is, sold to the domestic company in 2016 at its WDV for 35 lakhs. At the WDV at the time of original sale was 35 lakhs. Okay. Sold it to a domestic company. This is some other company, not our 100% subsidiary company. Okay. I mistakenly thought that 100% domestic company also it was plant and machinery. That was plot of land. So it's another adjustment. Now, in 2023-24, they reacquired the same plant and machinery. They reacquired the same plant and machinery at what value? Reacquired on 5th July 23 for 65 lakhs. So they reacquired the same plant and machinery for 65 lakhs. What to do? So this is the case of you had a plant and machinery, you sold it to someone else. Thereafter, you reacquired it again from the same person, the same plant and machinery. What to do? In such scenario, there is a thing called explanation to section 43. Okay, under PGBP, under the actual cost, there is an explanation that I have given. It is in page number 29 of our handbook. Okay, so page number 29, you can see a heading like this: explanation to section 43 subsection 1, actual cost in certain special circumstance. Under that, this item, second item, listen, where any asset which had once belonged to the assessee and had been used by him for the purpose of his business or profession and thereafter ceases to be his property by a reason of transfer is reacquired by him. You had an asset, you sold it. Thereafter, after some years, you reacquired that same particular asset. It's a sale and reacquisition. In such a case, how to compute actual cost for the purpose of depreciation? The actual cost shall be WDV at the time of original transfer of such asset or actual price for which the asset is reacquired by him, whichever is lower. Very simple. WDV at the time of original sale or reacquisition price, whichever is lower. So you tell me WDV at the time of sale in this question as per this chart was 35 lakhs. Reacquisition price is 65 lakhs. So which should be the actual cost? Lower. 35 lakhs should be the actual cost and you can claim depreciation on that 35 lakhs also. But you are not supposed to claim additional depreciation because it is a second-hand plant and machinery right now. It's already a used plant and machinery which is not eligible for additional depreciation. You can only charge normal depreciation. So our depreciation computation also have to be rectified. You have to make a correction over there also. Okay. Depreciation computation also went wrong. So you have to compute a change over there also. So plant and machinery sold and reacquired. Sold and reacquired. WDV at the time of sale. How much is the WDV at the time of sale? 35 lakhs. Or reacquisition price. How much is that? 65 lakhs. Whichever is lower. And which is lower? 35 lakhs into 15%. 5 lakh 25,000 also you can claim as what? Depreciation. This also should be there in the depreciation schedule. Okay. 5 lakh 25,000 also should be there in the depreciation schedule. Now you tell me how much is the total value of depreciation? Adding that also. 1 second. Yeah. How much is the total depreciation figure coming? 41 lakh 15,240 is the depreciation amount that is coming and you have to debit it to the statement of P&L account. So moving up, depreciation, we have to correct the figure. So this is the one I am correcting that figure. 41 lakh 15,240. 240 should be the depreciation. I think now it's clear, okay? Now you have to compute the PGBP income. How much is the total PGBP income coming? Come again? PGBP income is 74 lakh 89,760. Now under capital gain you have 262 400. Under IFOs and other heads there is nothing. So we can compute the gross total income right now. Gross total income. And can you help me, how much is the GTI gross total income? Adding these two figures, how much will be the gross total income figure coming? 77 lakh 52,260. And there is a chapter 6A deduction 65,000. In exam there is no problem if there is a vacant space in between, absolutely no problem. Okay, but here I am adjusting it. Okay, in exam you cannot adjust it like this, so that is fine. Here I am adjusting it to make it one page. So can you tell me how much is the total income? 76 lakh 87,260. That is the final answer to this question. Come again? Capital gain also have to be adjusted. Yes, 216. This is also added. That's why you got a total income of 77, 62, 260. Okay. So your total income will be 76 lakh 87,260. You wouldn't have to compute the tax liability in this question because that has not been asked. That's it. I hope it is clear for you. So we'll solve another question. So I want all of you to take the next question, that is question number 2. Okay. Question number 2, which is related to your capital gain. Mrs. Seema Agarwal, aged 56 years. So I want all of you to go through this particular question. It's a fantastic question. Again, May 2024, 4 marks. They have tested this question for 4 marks. So I want all of you to go through this question and give me the answer. Okay. Yes. So I hope you have read the question and we will solve it together. Question number 2. What they are saying is, Mrs. Seema Agarwal, aged 56 years, a resident individual, acquired a residential house at Ayodhya on 1/4/1993 for 45 lakhs. So she purchased some residential house at Ayodhya in the year 1993. So the first thing that you have to be careful is, this purchase happened before 1st April 2001. So while taking the cost of acquisition, you have to be a little bit careful. Now, the fair market value as on 1st April 2001 was 1 crore 20 lakh and the stamp duty value as on 1st April 2001 was 1 crore 2 lakh. Hope you remember. There is a thing in income tax law. What they are saying is, if you are purchasing a capital asset before 1st April 2001 and while determining its cost of acquisition, you either take its actual cost of acquisition or you take the fair market value as on 1st April 2001, whichever is higher. The act says whichever is beneficial, that obviously means whichever is higher. However, if it is a land or building or land and building, then what is the speciality? While computing the fair market value, the FMV shall not go beyond stamp duty value if available. What do you mean by that? That FMV shall not go beyond the SDV if it is available. So what you need to do is, in this question, the original cost of acquisition of that particular property in 1993 was 45 lakhs. The original COA is 45 lakhs. As on 1st April 2001, the fair market value is 1 crore 20 lakh. So it is 1 crore 20 lakh. Now, how about the stamp duty value? Is it available? Yes. And the stamp duty value is how much? It is, stamp duty value is 1 crore 2 lakh. So as you all know, what should be the cost of acquisition? 1 crore 2 lakh should be the cost of acquisition. Why? Because this FMB shall not go beyond 1 crore 2 lakh. This 1 crore 2 lakh and 45 lakhs have to be compared and you can pick the higher. And which is higher? 1 crore 2 lakh. I hope this much is clear. Now let's read the remaining part of the question. Mrs. Seema Agarwal sold a residential house located at Ayodhya to Mr. Shiv Kumar on 15th September, not 15th October 2023 for 15 crore 50 lakh. The value determined by the Stamp Valuation Authority was 17 crore. So there is another section that is called as 50C. Hope you remember 50C. What is 50C? Section 50C, what they are saying is, one second. According to section 50C, if you are selling a capital asset for a value which is lower than stamp duty value, then stamp duty value shall be deemed to be the full value consideration. Have you studied this? So according to section 50C, if you are selling a property and its SDV is more than 110% of actual consideration, then SDV have to be the full value consideration for the purpose of computing capital gain. Here you tell me how much is the stamp duty value in this question. It is 17 crore, right? How much is the actual consideration? 15 crore 50 lakh. Now how much is 110% of 15 crore 50 lakh? 110% of 15 crore 50 lakh. How much is that? 17 crore 5 lakh. Is SDV more than 17 crore 5 lakh? No, because SDV is high compared to the actual consideration, but SDV is not more than 110% of actual consideration. So section 50C is not applicable. Are you all with me? If you can take page number 221 in our handbook, there is section 50C, and what it says, special provision for full value consideration in certain cases. Asset being land or a building or both held as capital asset, if stamp duty value is more than 110% of transfer value, then stamp duty value shall be deemed to be the consideration. And there is one note under that. This is the pivotal note. What is that? If the stamp duty value does not exceed 110% of actual consideration received or accruing, then such consideration shall be deemed to be the full value consideration. That means the actual sale value itself you can take as full value consideration. So according to this, here we have to take the actual 15 crore 50 lakh itself as the full value consideration when you compute capital gain. I hope this much is also clear. So we will write this much first. Okay, we will write this much. So the full value consideration of that particular property will be how much? 15 crore 50 lakh. Don't take 17 crore, you know the reason. Section 50C not applicable. Section 50C not applicable since SDV not more than 110% of actual consideration. Actual consideration. This is the way you have to write the answer. Okay. Now, what is next? Direct expenses. Is there any direct expenses on transfer? We will read the remaining part of the question. So what are they saying is, the value determined by SDV we given. Mr. Shiv Kumar has handed over the possession of the property on 15/10/2023 and the registration process was completed on the same date. Okay. He paid the sale proceeds in full on the date of registration. So he paid the complete settlement on date of registration. After recovering sale proceeds from Shiv Kumar, Mrs. Seema Agarwal purchased one residential plot at Amritsar for 8 crore. So she sold a residential property and she purchased another residential property. And the section that you have to refer is section 54. So hope you remember section 54. If you are selling a residential house property and purchasing another residential house property, you can claim exemption. And how to claim the exemption? The purchase value of the new residential property is the exemption, and there is an amendment. There is an amendment in that respective section 54. And what is the 54 amendment? Let's see. Listen. The amendment, what it says is, for claiming exemption under section 54, there is a new insertion. Even if the cost of new residential house exceeds 10 crore, maximum exemption can be claimed by the assessee is only 10 crore. Even if the investment of the new residential property is more than 10 CR, maximum exemption shall be always restricted to 10 CR. So according to this, let's finish off the answer. How much is the maximum amount they have used for purchasing residential house? 8 crore. Not yet over. she also deposited 3 crore in savings account opened with the State Bank of India, Amritsar, under capital gains account scheme on 31st March 2024 for the construction of residential house on above plot. So, listen, very simple. What this, what is the name? Seema does is like, she purchased the plot of land first. That plot of land is purchased for acquiring residential house. Then she, for the plot of land, she incurred 8 crore. Okay. So, purchase of plot of land is a part of new residential house itself. So, absolutely no problem. You are not supposed to say that it's land, so you will not get deduction. It's not like that. For constructing a house, first you have to purchase a land. So, purchasing a land is definitely considered as purchase of house itself. So, 8 crore for the land, and she invested 3 crore in CGS account. How much? 3 crore. 3 crore in capital gains account scheme. So, altogether she have invested how much? 11 crore. But maximum exemption shall be only 10 crore. Are you with me? So, coming back to the point, there is no direct expenses, so directly go to cost of acquisition first. How much is the cost of acquisition? According to the theory that we have learned, cost of acquisition is 1 crore, 2 lakh. Yes or no? Is she eligible for indexation? Yes, she can claim the benefit of indexation, but only from 2001, 2002 onwards. So, into what is the index number in the year of transfer? Year of transfer is 23, 24. And the index number in the question is how much? It is 348 is the year of transfer. So, 2001-2 year of index number shall be 100. So, 348 by 100. 1 crore 2 lakh into 348 by 100. And can you help me how much is the cost of indexed cost of acquisition? 3 crore 54 lakh 96,000. Always you have to tell the figures in full, okay? 3 crore 54 lakh 96,000. So, how much is the long-term capital gain before exemption? 11 crore 95 lakh 4,000. Now, from that you can claim exemption under section 54. How much is the exemption under 54? For new land, it is 8 crore plus amount invested in CGAS is 3 crore, but it shall be maximum 10 crore, not more than 10 crore. So, you can claim an exemption up to 10 CR. And if you claim exemption up to 10 CR, how much will be the taxable long-term capital gain? 1 crore 95 lakh 4,000. Are they asking us to compute the tax liability? No. So, this is the final answer to the question. This is only an easy question, okay? This is one of the easiest question that they can give. And they are giving you 4 marks, okay? So, this is actually an easy question that is connected with section 54. I hope it is clear for you. See friends, when you claim exemption under 54, it is not like you invest in either new house for claiming exemption or you invest in CGS before filing return. It's not like that. You can do both. You can invest a part of the amount in new house and remaining part of the amount in CGS, but on a condition that the CGS amount have to be utilized for the construction or development of new house in future. Okay, that is the condition. Yes. Yes. So, moving on to the next question, friends. What is the next question? Question number 3. So, I want all of you to go through this question number 3. Again, a fantastic question it is. Okay. Go through question number 3 and give me the answer. Go through this question number 3 and give me the answer again. May 24. What is the mark weightage? 4 marks. They have tested this again for 4 marks. So, go through this question and give me the answer. So, let's solve it together, friends. So, this is actually a theory question, okay? This is actually a theory question. So, let's not waste a lot of time on this. Mr. Manju Menon, okay, whatever it is, an assessee from Coimbatore, okay, has 20% shareholding in private limited company, Aurelia Exports Private Limited. So, he is a shareholder of a company, private company. The assessee has immobile property in Coimbatore. It was let out to the said company on a monthly rent. The assessee permitted the company to provide said property as a collateral security to ABC bank in order to enable the said company to obtain loan from the said bank. So we will draw a chart based on this particular question. This is nothing, okay, but still let me draw it. Very simple. This assessee, okay, he had 20% stake in a company. He had 20% stake in a particular company. This company is a private limited company, okay, private limited company. He had 20% stake, share capital, okay. Now, what he did is like, he was let out to the said company on a monthly basis. So, he had an immovable property, he let it out, immovable property, he let out to the company on a monthly basis. The assessee permitted the company to provide the said property as a collateral security to ABC Limited in order to enable the said company to obtain loan from the said bank. Again, the company put this property, put this immovable property as a collateral in a bank, and the company took a loan, okay. The owner permitted it also. Now, consequently, the property was mortgaged to the bank in 2013, and that time, board of directors passed a resolution authorizing the assessee to obtain from the company interest-free deposit or advance up to 20 lakh as and when required for making available the said property as collateral security to the bank for loan facility enjoyed by the company. So, what they have done, the company have taken that immobile property and they have put it as a collateral. They mortgaged it in a bank and took a loan. As a consequence or as a compensation, the board of directors of this company have given a benefit to whom? To the original owner of the property, stating that this original owner can take an advance from the company up to 20 lakh as and when he requires money. So this offer is given to the owner of the property. Why? Because his property has been pledged by the company in a bank to get a loan. Are you all with me? Now, story is not over. In June 2023, Mr. Menon asked for an advance rent and he received a sum of 15 lakh from the company as advance rent in June 2023 and was to be adjusted against the rent payable to the assessee by the said company. So he took how much? 15 lakh as an advance rent. And he told the company to adjust. I have no plans to give back this 15 lakh. You can adjust it with the monthly rent. That's what the Mr. Menon said. This is Mr. Menon, okay. This guy is Mr. Menon. Now, then what has happened? After the adjustment for the year ended 31st March 2024, the amount of rent stood reduced to 8 lakh. So that 15 lakh came down to 8 lakh. The accumulated profits of the company as on 1st April 2023 amounted to 10 lakh. This company have an accumulated profit and this was 20 lakh. This company had some accumulated profit and the amount is 20 lakh. Sorry, 10 lakh. It was 10 lakh. Yeah. Then the assessing officer in the assessment order for assessment year 24-25 so to treat the said amount of 8 lakh as deemed dividend under 222E for Income Tax Act. So for the purpose of Income Tax Act, assessing officer treated that amount of 8 lakh as deemed dividend. What is this 8 lakh? Because 15 lakh has reduced to 8 lakh. Okay, 15 lakh has reduced to what? 8 lakh. They have adjusted it with the rent and it reduced to 8 lakh and department took this 8 lakh as deemed dividend. Can advance rent given to Manju Menon by the company be deemed as a dividend under section 222E as per Income Tax Act 1961? So the question is, can this advance taken by Mr. Menon be treated as a deemed dividend under section 222E? First of all, let's see what exactly is there in 222E. First of all, let's verify what is there in 222E. For that, you need to take IFOS and the page number is 232. In our handbook, the page number is 232. what you need to do is, under 232 there is a thing, loan by a private company to its shareholder under section 222E. Say for example, you are a closely held company. Closely held company means a private company. If gives an advance or a loan to a shareholder having 10% or more equity share capital, then the amount of loan up to the value of accumulated profit shall be deemed to be dividend. So let's see whether 222E applies here. So here our company is a private limited company, that is okay. Having accumulated profit, that is also okay. Has given an advance to a shareholder having how much shares? 20% share. So 10 is more than enough. Here he has 20% share. So 222E provisions may invoke. Section 222E provisions may come in if you read it in a plain manner. According to the plain reading, 222E may hit. But this amount given by the company to Mr. Menon is not a simple advance. That advance is in the nature of a compensation. Why? Because the company, Mr. Menon, allowed the company to pledge that particular property in a bank and take a loan. So this 20 lakh has been given based on that benefit given by the owner to the company. Okay, the owner has given a benefit to the company. Based on that benefit only, company decided to pay him an advance up to 20 lakh. So the same view have been settled in the case called Pradeep Kumar Malhotra. There is a case called Pradeep Kumar Malhotra. In the end of IFOS, we have given certain list of cases. This is the one, Pradeep Kumar Malhotra. Let's see. Can the loan or advance given to the shareholder by a company in return for advantage conferred on a company by the shareholder be deemed dividend under section 222E? Alright, let's understand. In the present case, assessee, a shareholder holding substantial voting power in a company, permitted his property to be mortgaged to the bank for enabling the company to take benefit of loan. The shareholder requested the company to release the property from mortgage. On failing to do so, for retaining the benefit of loan availed from the bank, the company gave an advance to the assessee. The exact same case. Shareholder permitted the company to mortgage the shareholder's property and to take a loan. And shareholder, instead of that, asked for an amount and the company have paid him an advance. Only gratuitous loan or advance given by the company to the shareholder would come under 222E, but not cases where loan or advance is given in return for an advantage conferred upon the company by such shareholder. This is not a gratuitous advance. Here, that 20 lakh advance was provided to the shareholder on for what? As a consideration for mortgaging that shareholder's property in a bank and getting a loan. So that advance is not considered as a gratuitous advance, and hence section 222E is not applicable. Are you with me? So you have to, how to write this in exam. Let's see the way of answering these kinds of questions. Let's see. See, the words by way of advance or loan in section 222E must be construed to mean those advances or loans which a shareholder enjoys simply on account of being a person who is beneficial owner of shares, not less than 10% of the voting power. You don't have to write in this language. You can actually write it in common language. Section 222E, advances means gratuitous advance. Okay. Normally, only gratuitous advance will come under section 222E. Then, in such loan or advance is given to such shareholder as a consequence of any further consideration received from such shareholder which is beneficial to the company, such advance or loan cannot be deemed dividend within the meaning of the act. Since in this case, it is not a gratuitous advance. Here, the owner allowed the company to pledge the property owned by the owner. Instead of that, only the company have given an advance up to 20 lakh. Then, gratuitous loan or advance given by the company to the shareholder who is a beneficial owner of the shares holding not less than 10% of the voting power would continue within the purview of 222E to the extent of accumulated profit of the company, but not cases where loan or advance is given in return for an advantage conferred upon the company by the shareholder. And the present case, 15 lakh was given by the company to the Menon holding 20% share as an advance for the property let out by him to the company, out of which 7 lakh was adjusted against rent payable, and the advance given by the company, since Mr. Menon mortgaged the personal property, thereby enabling the company to obtain loan from the bank. Therefore, such advance of 8 lakh outstanding as on 31st March 2024 cannot be brought within the purview of 222E, since it was not in the nature of gratuitous advance but was given as an advance rent and to protect the interest of the company. And as a note in the suggested answer, they have said that the facts of the case are similar to the facts in Pradeep Kumar Malhotra. wherein the above issue came up before Calcutta High Court. Above answer is based on the rationale of Calcutta High Court in the said case. Even if you don't write the case law name, you will get full marks if you write the content. You don't have to write the content in the legal language. You can write the content in your own language. That is also perfectly all right. But you need to convey the point. That's it. Are you all with me? I hope that is also clear for you. So moving on to the next question, friends. Now question number 4. Go through this question number 4. Again 4-mark question. Sorry, 6-mark question. Okay, not 4-mark. 6-mark question. So go through this question number 4 and give me the answer. Alright friends, so let's read the question and we will solve it together. There's nothing. Okay. Miles Incorporate, a company incorporated in US. So it's a foreign company engaged in development of infrastructure and providing consultancy in the same field. During 23-24, its shareholders met in India for 3 times. The first 2 times were held to discuss the modification of rights attached to various classes of shares, and the third meeting was held to discuss and decide about the sale of companies' assets situated in India. So first of all, it is a foreign company. Their shareholders met thrice in India. Shareholder meeting is actually not a criteria for determining their place of effective management. A foreign company can become an Indian resident if its place of effective management is in India. But for determining place of effective management, board of directors meeting is a criteria. Shareholders meeting is not a criteria. So the meeting of board of directors were held in Chicago, USA, where the management and commercial decisions are necessary for the conduct of the company business are taken. So it is incorporated in USA, and a board of directors meeting also held in USA. So what is the conclusion? It's a non-resident foreign company because its place of management is outside India. Are you with me? So first of all, it provides you following additional information pertaining to the financial year 23-24. You have something related to dividend and FTS. You are required to determine the residential status of Miles Incorporated. Straight away we can write. Meeting of shareholders is not a criteria for deciding what? Place of effective management. Here the question clearly says that it's a US incorporated company, as well as the board of directors of that particular company met in USA, and the business decisions are actually taken in USA. So irrespective of whether shareholders meeting held in India, the company will become NR in India. The company is a non-resident foreign company. That theory part you can write by yourself. Okay, I'm not writing it in my answer. Now, and compute the total income for the assessment year and briefly explain the relevant provisions of Income Tax Act 1961. So we have to compute the total income. That part we will compute it together. So tell me, what is the first item? They're saying dividend received 5,50,000. That is, they've clearly mentioned net of TDS. Okay, now there is no scope of assumption. They've said that it is net of TDS. On GDR, Global Depository Receipts of Z Limited, an Indian company issued under a scheme of central government against initial issue of shares of the company and purchased by the Miles in foreign currency through approved intermediary. So you tell me, which section are they referring? They are referring to 115 AC. Okay, so we will go to 115 AC and we will check what exactly is given under 115 AC. So listen. Under section 115 AC, what department say is, if you are a non-resident and receiving dividend from GDR, so this one it is. This is the item. Okay. So if you are a non-resident, if you are what? A non-resident and you are receiving what? Dividend income on GDR. According to 115 AC, what is the rate of tax for that GDR? It is taxable at 10%. And according to section 196C, TDS shall be deducted at the time of payment or crediting, whichever is earlier. And what is the rate of TDS? 10% plus surcharge if any plus 4% cess. So you have to deduct including cess. Yeah. So as you all know, in this question, what they are saying is dividend received is how much? How much is the dividend received? We'll use this format, okay? Particulars, then analysis, amount. For NR taxation, go for this format. If they are asking us to compute the rate of tax, then again, rate of tax and basic tax. 2 more columns you have to add, okay? Now, particulars, first one dividend. They have given net of TDS. So how much is the amount they have mentioning? 5,50,000. This 5,50,000 is net of TDS. How much is TDS? TDS is 10 percentage plus 4% cess. Don't say that 14. Okay. On basic tax only you are supposed to add cess. So effectively what will be the rate? 10.4%. 10.4% is the effective rate of TDS. So this is net of TDS. That simply means it is 89.6 of the original figure. And how much is 5,50,000 divided by 89.6? 6,13,839. You can round off, okay? You can round off and say 6,13,839. Under section 115 AC at the rate 10 percentage plus 4% cess. I hope that is clear. Moving on to the next one. What is the next one? Fees for technical services received from Government of India, that is 5,50,000. The Government of India utilized such services for a development project carried out by it in Nepal. So in this case, anyways, 44 DA will not come. Why? Because they don't have any P in India. And we don't know whether there is an agreement with central government. Normally, central government will obviously go for a agreement. Without agreement, central government will not accept any services. Are you with me? Obviously, there will be an agreement. Central government will not orally accept any services and will not give any remuneration. Obviously, there will be an agreement. So, we can say that it will be taxable under section 115A. Why? Because there is an agreement and it is you are dealing with central government and it is FTS. So, the taxability will be under 115A only. Are you with me? If instead of central government, if it is a private party, then you can take an assumption. There is no agreement and it is taxable as per the normal rate. But this case, don't take any assumption because CG will never do something without any agreement. Yes. So what we can say is it will be taxable under 115A. So FTS, they are saying received, right? I note that, one second. They are using the word received from government 5,55,000. If they are using the word received, then what should be the assumption? Net of TDS. Now go refer 115A. We have to refer 115A. According to the 115A, friends, tell me what is the rate of tax for FTS? Royalty or FTS other than income referred under 44DA shall be taxed at what rate? 20% rate. So the TDS would be how much? 20% basic tax plus 4% cess. Effectively, it would be 20.8%. Are you with me? Now, coming back to this particular adjustment, the income here is 5,55,000. So what you need to do is 5,55,000 is how much? 79.2% of something because TDS rate is 20.8. and the net off will be 79.2. And can you tell me how much will be the effective grossed up amount? 7,758,000. So under section 115A, taxed at 20% plus 4% cess. That's it. Now can you tell me how much is the total income? 6 plus 7, that will be 13 lakh. How much is 13 lakh? 14,597. This is the taxable total income in the question. It is only a simple question and they are providing us 6 marks for this. You know 2 sections, you will get the answer. Plus you should know place of effective management as well. I hope it is clear for you. Are you all with me? Are you all with me? Great. Okay friends, so let's continue our discussion in May 2024 question paper. The next thing that we have to solve is question number 5. That is related to assessment of charitable and religious trust. Okay, it's actually theory question. They're asking a question in relation to assessment of charitable and religious trust. It has been asked for 8 marks. That means 4 into 2, 8 marks. So please go through this question and give me the answer. It's not a very lengthy question, so you can just go through that question quickly and we'll solve it together. Okay. So let's solve it together. It's an easy question only. So it's just like simple. Please answer the following independent questions with regard to the provisions applicable to charitable trust as per Income Tax Act 1961. So as I've told you, for certain 2, 3, 4 attempts, they are keep on asking theory question or theory based question in charitable trust chapter. Anyways, so sub question number 1, Devayani Trust is a registered charitable trust under 12AB. During the previous year 23-24, the trust has applied 4,50,000 for the benefit of trustee. So trustee, as you all know, is an interested person. So mentioned under 13 subsection 3. So if you are spending something for the benefit of interested person, then what will happen? Hope you remember, there were certain consequences if you are applying income for the benefit of interested person. Let's understand which are the consequences. So this is the one. Listen, income of a trust has applied for the benefit of interested person, that what will happen? Such income cannot be claimed as an application. You cannot claim that as an application. Such income shall be deemed to be specified income under 115 BBI, taxable at 30%. Then there is a penalty. First time, 100% of the transaction. Subsequent time, 200% of the transaction, right? Non-applicability of relaxation under 56 subsection 2 clause 10. That means the recipient will not get the benefit of exemption. That will be fully taxable in his hands. So moving on, friends, what they are saying is they have applied 4,50,000 for the benefit of interested person. So that 4,50,000 is definitely going to be a taxable income under 115 BBI. So we will make use of this format for answering the question. Particulars amount. Particulars amount. In the particulars column, we can write trust or amount applied for the benefit of interested person. Okay. Amount applied for trustee, that is interested person under section 13 subsection 3. And how much is the amount? 4,50,000 will be a taxable amount under 115 BBI. Then what is the next one? And 2,50,000 for the benefit of Mr. Sujan Dev, who was donated 3,75,000 rupees to the trust up to 31st March 2024. He is a substantial contributor. If you are a person who contributed more than 50,000 in a year, you will be considered as a substantial contributor. And the trust cannot apply any amount for the benefit of a substantial contributor. Why? Because he is also an interested person. So we can write amount applied for substantial contributor mentioned under 13 subsection 3. That is also taxable under 115 BBI. And how much is that income? 2,50,000. Okay. Moving on. What is next? Also amount of 2,50,000 set apart in the previous year 21-22 by the trust for charitable purpose under section 11 subsection 2 has been utilized in the previous year 23-24 for making donation to another registered charitable trust with similar object as Devayani Trust. Another problem. You have accumulated some amount and now you have donated it to some other person. If you are accumulating the amount, you must use it for your own objective only. You are not supposed to donate it to some other person. It's a violation under 11 subsection 3. Okay. Hope you remember we have studied violations under 11 subsection 3. If you are a trust and you are you are applying any amount, or that means you are accumulating any amount, that accumulated portion only have to be utilized for your own objective. You are not supposed to give any contribution out of that accumulated portion. But current year income portion, you can give donations to other trust if it is a normal donation, and you can claim 85% of that as a deduction. Here, that also is a violation, taxable under 115 BBI. So, amount donated out of accumulated fund. How much is the amount? Accumulated fund 2,50,000 again. Now, what is next? Is there anything else in the question? What is the amount of specified income taxable under 30% under 115 BBI for assessment year 24-25? Explain with reasons. My God, it's such an easy question, okay? And what is the total? 9,50,000. 9,50,000 is the total income taxable under section 115 BBI. And the rate of tax shall be at 30%. They haven't asked the tax liability, so we can, finish off our answer by writing 9,50,000. I hope it is clear. You don't require any further explanation. This is such an easy question only. Moving on to the next concept or the sub question. What is that? Sub question 2. Pavitram Charitable Trust has been incorporated on 1/6/2022 and immediately commenced its activities of providing relief of poor. Okay, they started their activities immediately. During the year 22-23, it failed to file an application for provisional registration under section 12A, subsection 1, clause number AC. However, on 1/1/2024, it had been applied for final registration as per 12AB, read with 12A, subsection 1, clause number AC, in prescribed form to avail exemption under section 11 for assessment year 24-25. So this is something related to registration. Okay, first of all, in registration, you should understand there are 2-3 things. So let's go to the registration of trust rights now. So regarding registration, you can check it is in page number 112 of our handbook. I have given a column like this. Okay, so registration process, as you all know right now, registration is under 12AB. That means for 5 years only you will get registration. If you are a registered trust already, you need to mandatorily convert your registration to 12AB. That means this is with effect from 1st April 2021. This 12AB came with effect from 1st April 2021. If you are a registered trust already before 1st April 2021, then you need to convert your registration to mandatorily under 12AB. Now, under 12AB, there is a thing called provisional registration. Listen, provisional registration simply means if you are a trust, you haven't started your activity. You are a trust and you haven't started your activity, then you can provisionally register. You can actually give a application for provisional registration. Once you actually start your activity, you can convert that provisional registration into final registration. This is what the department say. This is the last point, is one which is related to provisional registration. In any other case, at least 1 month prior to the commencement of previous year, relevant to the assessment year in which registration is sought. Whenever you are planning for the registration, just before 1 month, you apply the form number 10A to the principal commissioner or commissioner. Within 1 month from the end of the month in which the application is made to be passed for provisional registration without detailed enquiry, the principal commissioner or the commissioner will, without detailed enquiry, if you give an application in form number 10A like this, he will, without a detailed inquiry, he will give you the provisional registration. He will allow the provisional registration. That's what they are saying. Now, this provisional registration is valid for 3 years. It is valid only for 3 years. Now. After 3 years, either before end of 3 years or before you start your activity, whichever is earlier, you have to convert it into what? Final registration. Because this is not a final registration. This is only a registration for the time being. Provisional registration means registration for a time being. Once you start your activity, you need to convert it into final registration. Now, so let's understand final registration where the trust is provisionally registered. So please listen. At least 6 months prior to the expiry of the period of provisional registration. That means provisional registration is valid only for maximum 3 years. So before expiry of 3 years, before 3 months to the expiry, 6 months to the expiry of 3 years, you mandatorily have to apply for final registration, or within 6 months of commencement of activity, whichever is earlier. If you are starting your activities even before that, you must apply for registration from the date of commencement of your activity within 6 months. So whichever is earlier. The conversion form is form number 10AB. Now, there is a note. In case where the above time limit expires before 30th September 2023, the last days has been extended to 30th September 2023. That is an explanation given. Now the question here is, say I am a trust. I have already started my activity. Shall I have to mandatorily go for provisional registration? Then I have to convert it into final registration? The answer is no. If you haven't started your activity, you can go for provisional registration. If you are a trust, from the very first day onwards you are starting your activity, you can directly go for final registration. This provisional registration is not mandatory. Okay, so let's go back to the question and understand what exactly is the question. Is the action of the trust justified? That means what they have done, Pavitram Charitable Trust has been incorporated on 1/6/22. Immediately commenced its activities for providing relief. During 22-23, it failed for application for provisional registration. However, on 1/4/24, it applied for final registration. in the prescribed form. Is the action justified? Can the trust apply for final registration before applying for provisional registration? If yes, what is the time period up to which the principal commissioner or commissioner will have to pass the order granting or rejecting the registration? And the registration, if granted, will be applicable from which assessment year? Explain your answer based on the latest income tax provisions. Let's see the answer. You know the answer already, but still, let's go through the official answer. What they are saying: since Pavitram Trust has already commenced this activity, it has not availed exemption under section 11 for any PY ending on or before 1st April 2024 being the date of application. It need not first apply for provisional registration. It can at any time after the commencement of such activities directly apply for final registration under section 12A(b). Cross this 3. Okay. So you can directly go for final registration. It is not mandatory that you always have to go for provisional registration. Now, thus the action of the trust for applying final registration as per 12AB before applying for provisional registration for exemption under 11 is valid. That simply means directly going and getting registered as a final or directly applying for final registration is definitely valid. There is no problem in that. The principal commissioner or commissioner has to pass an order granting or rejecting the registration before expiry of 6 months from the end of the month in which the application is received by, that is 31st July 2024. So whenever you have given that application, from that date within 6 months, from that date's month end, 6 months they have to reply, either reject or approve. Say for example, in this question, when was the date of application? Date of application of final registration, 1st January 2024. Yes or no? 1st January 2024 was the date of application. If you apply on or before 1st January 2024, then how long will the principal commissioner take for completing the registration process? Department say it is 6 months. Within 6 months from the end of the month in which application was received after satisfying himself the genuineness of activities. That's what they are saying. So listen, you have given an application on 1st January 2024. So month end means 31st January 2024. 6 months from the month end means 31st July 2024. Okay, so that's why here we have written by 31st July 2024. That means application is on 1st January 24. End means 31st January 24. 6 months means 31st July 24. Exemption under 11 and 12 would be applicable from assessment year immediately following the financial year in which the application is made. That means from assessment year 24-25. That means previous year 23-24 only you will get exemption. Why? Because you have applied in 1st January 2024. That means for which assessment year? 24-25 assessment year only you have applied. That simply means for the PY 23-24 only you will get the benefit of exemption. But you have started your activity in 22. For 22-23 you will not get the benefit of any exemption. Why? Because you haven't applied for any registration. Are you with me? So I hope that point is clear. So two things are there. There is an option called provisional registration. This is not mandatory. If you are starting your activity, directly you can go for final registration. That is the crux of this particular question. I hope that also is clear. These are actually simple things. Okay. But there is one more thing, friends. In charitable trust, if they ask a theory question, they can mix up that question from different area. If it is a numerical question, it's just like a one-way question. Okay. So always expect a theory question from this respective chapter in the upcoming exam. So it is always better to cover the entire chapter because one question will be there, that's for sure. You can expect at least 6 to 8 marks from this chapter. Every attempt, they consistently ask questions from this chapter. Okay. So moving on to the next question. I want all of you to go through this question number 6. Fantastic question it is. Okay. This is related to our DTAA. So go through this particular question and give me the answer. It has been tested for 6 marks. So just go through this question and give me the answer, friends. 6 mark question it is. Okay, friends. So let's move on to the answer. Let's read the question together and let's solve the answer together. So please listen. The following are the particulars of income earned by Mr. Kumar Saurav, whatever it is, SK, okay, KS, a resident Indian aged 56 years in India and from country P for assessment year 24-25. Income from India, income from country P. Okay, now you are required to compute the total income and the net tax liability of Mr. Kumar Saurav in India for the assessment year 24-25, assuming that India has not entered into double taxation avoidance agreement with country P. Assume that Mr. Kumar Saurav pays tax under default tax rate under 115 BAC. It carries 6 marks. So the question is actually a mix of DTAA as well as assessment of individuals. So you know that India have not entered into a double taxation agreement with country P. That means which relief they are referring to? Unilateral relief, which is under section 91 of Income Tax Act. So they are referring to unilateral relief, and let's solve the answer without wasting time. So listen. The first point they're saying is whenever you compute the unilateral relief, you have to do the computation what headwise. Okay, so we will be solving this question headwise. Yes, income from profession in India. So Indian income from profession, that will be under PGBP. So PGBP, income from profession. And how much is the amount? It is 10,75,000. So 10,75,000 is the income from profession. Then what is the second item? That is income interest on fixed deposit with XYZ bank. Interest on fixed deposit. You will get a deduction under, it have to be assessed under IFOS. So IFOS it is. So I'll write here. In exam you have to write it after leaving some space under PGBP. Okay, write it under. Here to bring everything in one page, I am writing it. Consider these two as 2 pages. Okay, this is page 1 and this is page 2. Yeah, so IFOS. So interest on fixed deposit, and how much is the interest? 95,000. Then next one, interest on savings bank, 47,000. Savings bank account again under IFOS. So SB interest 47,000. At this moment itself, you have to do one thing. Normally, assessees are eligible to claim 80 TTA deduction. Normally, assessees they can claim the benefit of 80 TTA. But this case, since the assessee has opted for 115 BAC, he cannot claim the benefit of 80 TTA. That you have to write in note. Okay, otherwise you lose the marks. So what you need to do is, you have to write chapter 6A and then write under section 80 TTA nil. Why? Assessee opted or assessee taxed under default tax rate. Default tax rate under section 115 BAC. This should be there. Otherwise, they will definitely deduct some mark from your final answer. That means you have to study all the chapter 6 reduction. Then you have to write it's not applicable, not applicable, not applicable. That doesn't make any difference for student. Okay, he need to study whether it is old or new. He need to study everything. Okay, got it. Moving on. Now the other incomes are from country P. Country P, which all other incomes? Number 1, income from country P, rate of tax 16%. Okay, fine. Agricultural income, country P, gross 65,000. So they have written that it is gross. So agricultural income under IFOS. So agri income. Agri income, and the amount is 65,000 from country P. Then what is the next item? Royalty income from literary book from country P. So you have some literary book from country P, royalty income 4,50,000. So we can write royalty, country P. Then is there any expenses? Yes, there are certain related expenses also. So how much is the expense? 35,000. So 4,50,000 is the income and expenses 35,000. Can you help me with the math? How much will be the net income? Royalty income net of, can you help me with the math? How much is the net of amount? 415. So 4,15,000 is the net income from royalty. Now you have to write another thing. Under section 80 QQB, normally assessee can claim deduction, but here assessee cannot. Why? Because assessee is getting taxed under section 115 BAC. Hence, he cannot claim chapter 6A deduction, AQQB. If assessee has opted for 115 BAC, then he can claim only two chapter 6A deductions. Number 1, 80 JJAA, and 3 is there actually right now. Number 1, 80 JJAA. Number 2, 80 CCD subsection 2, and number 3, 80 CCH subsection 2. That is contribution towards Agniveer Corpus Fund. Okay, that also is allowable as deduction. That is a new deduction which is inserted with effect from, which is inserted as a part of February 2023 annual budget. Okay, CCH is also there. So these are the three things that you can claim as deduction. So all other chapter 6A deductions are fully disallowed. I mean, disallowed means not deductible. That's it. Moving on to the next item. What is that? Dividend from company incorporated in country P. So we have dividend from company incorporated in country P. What to do? IFOS will be taxable under IFOS. So we'll write dividend. And how much is the dividend income given in the question? That is 1,59,000. Then rent from house property situated in country P. So house property head, rent, how much is the rental income? It is 1,92,000. And they are saying municipal tax in respect of the above house not allowed as a deduction in country P. Doesn't matter. We always compute the relief according to the Indian income tax law. We don't follow the foreign law normally computing the total income here. So whenever you compute your total income under unilateral relief, I hope you remember the theory. Okay, we'll go to the theory. Listen. So this is how you compute the unilateral relief. Listen, whenever you compute the total income, compute Indian income as per Indian Income Tax Act. Then compute foreign income as per Indian Income Tax Act. So when you compute the foreign income also, you have to follow Indian income tax. Municipal tax, whether it is deductible according to the foreign law, is not at all our concern. Our concern is whether it is taxable in, whether it is deductible in India. Now, then you add these two and claim chapter 6A deductions. Then total income as per Income Tax Act in India will get, compute the tax liability including surcharge and cess, then relief. How do you compute relief? Compute the doubly taxed income, apply the rate of tax in India or rate of tax in the foreign country, whichever is lower on the doubly taxed income, you will get a figure. That figure have to be deducted from the tax liability you computed earlier, then you will get the net tax payable. This is how you have to compute unilateral relief under section 91. I hope you got my point. Moving on. In this case, you can definitely deduct the municipal taxes 9,500. Whether it is allowable as a deduction in country P or not is not our relevant factor while computing Indian income tax law. So municipal taxes paid, and how much is the municipal tax paid? 9,500. You deduct that. How much is net annual value? 1,82,500. You can claim standard deduction at the rate 30%. And how much will be standard deduction? 54,750. You deduct that. How much will be your net income? 1,27,750 will be the income from house property. Now, what are they asking us to compute? You are required to compute the total income, net tax liability of Mr. Kumar in India for assessment year 24-25, assuming that India does not have a DTAA with that particular country. Assume Mr. Kumar pays tax under default tax regime. You will get 6 marks if you compute this. Okay, this is another easy question. Only there is nothing complicated in this question. Okay, there is nothing complicated. Now you tell me how much is the gross total income. Let's compute the GTI first of all. Before that, you need to compute the total income under IFOS. How much is the income under IFOS? You add everything and can you tell me, help me with the math, how much is the income under IFOS? 7,81,000 is the income under IFOS. Now, add everything together and compute the GTI. 781, 1075, 127,750. Add everything. 19,83,750. There is no chapter 6A reduction So that same figure will be your total income. 19,83,750. Now you compute the tax liability under 115 BAC. So basic tax liability. How do you compute basic tax liability? Up to 3 lakh nil. Then 3 lakh to 6 lakh. What is the percentage? At 5%. How much is 3 lakh into 5%? That will be 15,000. Then 6 lakhs to 9 lakh, it is at 10%. How much is 6 lakhs to 9 lakh? 3 lakh into 10%, that will be 30,000. Then 9 lakh to 12 lakh, it is taxed at 15%. That is that 3 lakh into 15% will be 45,000. Then 12 to 15. 12 lakh to 15 lakh, it is taxed at 20%. And how much is 20%? So 3 lakh into 20% will be 60,000. And finally more than 15 lakh, that is 4,83,750 into 30%. And can you help me with the math? 1,45,125. So can you add everything together and help me with the basic tax liability? 2,95,110. 122 on 120. Say it properly, yaar. 2,95,125. And there will be cess at 4%. There won't be surcharge since the income is less than 50 lakhs. So 4% cess means how much is the cess? 11,805. Add everything together. How much will be the amount? 3,06,930. Now, not yet over. Now you need to compute the unilateral relief. So under section 91, first of all, you compute doubly taxed income. How do you compute doubly taxed income? Very simple. First, you go and identify which all are the incomes that are taxable both in country P and in India. Number 1, agricultural income. Number 2, royalty income 4,15,000. Number 3, dividend income 159. Number 4, house property income 127,750. So you take the total of 1, 2, 3, 4. You will get the doubly taxed income. So can you help me with the doubly taxed income total? So we'll add everything together. 127,750. 127,750 house property income plus how much is dividend? 65,000 is their agricultural income plus how much is royalty income? 4,15,000. And how much is the dividend income? 59,000. Can you help me in the math? Doubly tax income in total? 7,66,750. Now, not yet over. Now you need to compute the rate of tax in India. How do you compute rate in India? We know the tax liability in India, that is 3,06,930. So 3,06,930 divided by how much is the total income? 19,83,750. 19,83,750. So can you help me? What is the percentage? 15.472%. Okay. Now, what is the rate in foreign country? Rate in foreign country is given as 16%. So whichever is lower is 15% into doubly taxed income. So 15.472% on doubly taxed income. And can you help me? How much will be the relief? 1,18,631 will be the relief amount. You claim that relief from the tax liability, and how much will be your final tax liability? Final tax liability will be 1,88,299 or 98. You can round it off to 300. Absolutely no problem. And this is the final answer. There is nothing complicated in this. Okay, it's a straightforward question only. I hope it is clear for you. So let's move on to the next question. Yes. Next is question number 7, that is related to TDS. So go through the sub questions 1, 2 and 3. Each sub question carries, first 2 sub question carries 3 marks and the last sub question carries only 2 marks. So go through these questions and give me the answer. It's related to TDS, TCS. Okay friends, so let's solve it together. Theory question only. So let's not waste a lot of time on this. Okay. Examine the applicability of tax deducted at source or collected at source and calculate the amount of TDS or TCS in the following independent cases as per the provisions applicable for assessment year 24-25. Number 1, Rajesh Kesari some hotels and resorts limited. So we will call RK Hotels and Resorts Limited is engaged in the business of owning and operating and managing hotels during the previous year. The tips are paid by the guest by way of charge to credit cards upon UPI or net banking in the bills. The company disbursed the same to the employees at periodic intervals. Explain with reason whether the company is responsible for deducting tax at source from disbursement of tips to its employees. So this question carries 3 marks. Okay. And this is related to which section? Section 192, that is TDS on salary. Yeah. So we'll do one thing, we'll jump to TDS chapter. Yes, TDS TCS, that is, it's in page number 241 in our, what do you say, handbook. Okay. So TDS on salary, who is the deductor? Employer. What is the rate? Average rate of income tax. When TDS at the time of payment, who is the payee? Employee, can be resident as well as non-resident. Now, in that chapter, there is a case law. If you go under that, I have highlighted it. It's a case law is there that is called as ITC Limited. It is cited by the Supreme Court in the year 2016. And what is the summary? If tips are paid directly to the waiters or paid through employers, TDS shall not be required to be deducted on such tips. And the same shall not be regarded as a part of salary. It is cited by the Supreme Court. Now we'll come back to this case. Not case, to the question. Okay. What happened? Customers, they were directly crediting some amount. Customers, waiters and hotel. The customers, while making use of credit card, have credited something to the hotel as tips to the waiters. The hotel paid these tips to the waiters without deducting tax at source. Now the question is whether the hotel is required to deduct TDS on the tip. On salary, definitely the hotel is supposed to deduct TDS. On the tip, whether they are required to deduct TDS, that is the question. And now you already know the answer. What is the answer? Not required to deduct. And let's see how to frame the answer. Maximum 3 or 4 sentences or 4 or 5 sentences, more than enough. In respect of tips collected by the company from guests and dispersed to the employees, the person responsible for paying the employee was not employer at all, but a third party, namely the guest. Actually, the guest pays tips to the waiters, not the employer paying tips to the waiters. It is paid through employer. So employer is a kind of an agent between the customer and the employee. Now, the payments of collected tips included and paid by way of credit card, UPI, net banking in the bill by the guest would not be payment made by or on behalf of the employer. The employer is supposed to deduct TDS only on the portion of salary. Okay. Now, the contract of employment not be proximate cause of for the receipt of tips by the employee from the guest. Such payments would be outside the scope of section 15 and 17. 15 is the charging section. Okay. So, the tip portion is not a chargeable income under the head salary because the tip is not paid on account of employer-employee relationship. There is no employer-employee relationship between the customers and the employee of the hotel, and therefore such payments do not fall within the nature of salary. On account of such tips, receipt from the guest, not from the employer, section 192 would not get attracted at all in the hands of that hotels. Thus, the company is not responsible for deducting tax at source from the disbursement of tips to its employees. It is actually a case. ITC Limited, CIT versus CIT in the year 2016, cited by the Supreme Court. I hope it is clear. Now, if you know the case law, that's it. Moving on to the next one, sub question number 2. What is sub question number 2? Lalit, an individual whose turnover in business during the year ended 31st March 2023, that means 22-23's turnover is given. How much is that? 1.50 crore. opted to compute income under 44 AD, that is presumptive taxation for assessment year 23-24. That means 22-23 he opted for presumptive taxation. All right. He paid 5 lakh by check on 1st February 2024 to the contractor. So now the payment is happening in the year 2023-24. Contractor and individual for construction of his factory building. No amount was credited earlier on account of contractor in the books of accounts of Lilith. So this is in relation to contract payment, right? The turnover of Mr. Lilith for the previous year, that is 23-24, is 95 lakhs. That means 23-24's turnover is given, that is 95 lakhs only. Are you all with me? Now moving on, 23-24's turnover is given. He also pays a monthly rent of from 1st April 2023 to 31st March 2024 of 16,000 per month for office premises to Mr. Hemant, owner of the building. Besides, he also pays service charges of 5,500 per month to Hemant towards the use of furniture, fixtures and vacant land appurtenant to the office. Examine the obligation of tax deducted at source for assessment year 24-25. So two sections will come into the picture. Okay, there are actually two sections will come into the picture. One is 194C and the other one is 194I. So let's check the applicability of both the sections, 194C and 194I. So first under section 194C, second under section 194I. What is 194C? Let's go to the handbook and check what is 194C. That is payment to contractors for work done or payment to subcontractors for work done. Let's see. 194C, what they are saying. So, who is the deductor? Any person other than individual, HUF, AOP or BOI. Individuals and HUF will become deductor only if their preceding financial year turnover exceeds how much? 1 crore or professional gross receipts exceeds 50 lakh. So, in this question, it is very much clear that that particular person's preceding financial year turnover, they are a partnership firm, right? Sorry, that's the next question. It is an individual, right? He is an individual and his preceding financial year turnover is 1.50 crore. So he will become a deductor according to 194C. Yes or no? So he will become a deductor according to 194C because there is a contract payment involved. Now what is the percentage? If the payee is individual or HUF, that means the person who receives the payment, if he is an individual or HUF, rate 1%. If the payee is a company, firm, etc., rate shall be 2%. Now let's see what exactly is the criteria of the payee. What is the criteria of payee? The turnover, contractor and individual. So the contractor is an individual. So your payee is an individual and the rate of TDS shall be at 1%. Yes or no? Yes or no? Your payee is individual, hence the rate of TDS shall be 1%. It shall be deducted at the time of credit or payment, whichever is earlier. Now the payee can have to be a resident, contractor or a subcontractor. Now there is one thing. If the individual contract value does not exceed 30,000, no need to deduct any TDS. And there are many individual contracts and altogether it does not exceed 1 lakh. Say in a year there are multiple individual contracts from one person to another. So here the payee is a individual and there are different individual contracts and the aggregate value exceeds 1 lakh, also you need to deduct TDS. Now let's see what is the aggregate value of this case. What is the aggregate value? They are saying he paid 5 lakh by check. So anyways they have to deduct the TDS for construction of his factory. Construction is actually a work. So you have to definitely deduct what? TDS. And now you tell me what is the amount of TDS for the first case? 5 lakh is the total amount. 5 lakh into 1% and that will be rupees 5,000. So Mr. Lalit have to deduct TDS at 1%, that is rupees 5,000 in first case. And how about the second case? Besides, he also pay monthly rent starting from 1st April 23 to 31st March 2024. So rent is under 194I. So let's move on to 194I. Let's jump to 194I and this is 194I, rent under section 194I. There also deductor can be any assessee other than individuals and HUF. Individual and HUF will become deductor only if their preceding financial year turnover exceeds 1 CR or professional gross receipts exceeds 50 lakhs. So here we don't have to check again. Here the person will become what? Deductor. Why? Because preceding financial year turnover is around more than 1 crore, right? Now, what is the rate of TDS? There are two rates. If the rent is related to plant and machinery or equipment, 2%. For other rent, it is 10%. It have to be deducted at the time of credit or payment, whichever is earlier. Now, the payee have to be a resident. Now, the interesting thing is, if aggregate rent credited during the previous year does not exceed 2,40,000, TDS is not required to be deducted. That means aggregate rent paid during the year does not exceed how much? 2,40,000. TDS is not required to be deducted. Now, there are two payments in the question. Okay, one is 16,000 per month, and that 16,000 per month is for what they are saying? It is for the office premises, right? That 16,000 is for the office premises, and one more thing is there, 5,500, that is for the furniture, fixtures, and vacant land. So there are two payments, two agreements, but between the same person. Now the question is, if you take that 16,000 alone into 12 months, how much will be the rent figure coming? 16,000 alone into 12 months, how much will be the rent figure coming? 1,92,000. How much is 5,000 alone into 12? It is 66,000. Now the question is, if we take it separately, both are under 2,40,000. Yes or no? But you need to take it together because it is from the same persons. Because the payer and the payee is only one and same. So you have to consider both. If you take it together, how much will be the threshold? 2,58,000 is the threshold. So definitely you have to deduct the TDS. And what should be the rate of TDS? 10% only. Because one is for building and the other is for some vacant land, furniture, fixtures, etc. Both rates shall be 10%. So 10% on 2,58,000, how much it will be? That is 25,800 shall be the TDS amount that have to be deducted by the deductor. I hope that is also clear for you. So in both cases, one under 194C and the other under 194I, both you have to deduct the TDS. Are you all with me? One more sub question is there. So let's finish off that sub question also. What is the third sub question? Listen, that is, they are asking, the mark weightage is for 2 marks only. Okay. So X, Y and Co, a partnership firm selling its product R through a digital facility. Whenever you hear digital facility and TDS, one thing should come into your mind, that is 194O. So provided by ABC Limited, an e-commerce operator, on 28th February 2024. ABC Limited credited in its books of accounts an account of XYZ company with a sum of 4,90,000 for online sale of products R made during the month of February 2024. The company realized a payment of 4,30,000 on 6th March 2024 to XYZ and Co. Out of the above sales made during February, Mr. Rani, who purchased the products R through the digital facility of ABC Limited, made payment of 60,000 directly to XY and Co. on 15th March 2024. So you are supposed to talk about the or discuss about the applicability of TDS over there. For that, let's go to 194O. What is 194O? Let's see. Listen. That is TDS, payment by e-com operator. That means e-commerce operator to e-commerce participant. Who is an e-commerce operator? E-commerce operator simply means Amazon, Flipkart, Meesho, etc., etc. Snapdeal, eBay, etc. can be what? E-commerce operator. That means the digital facility shall be the deductor. What is the rate of TDS? 1% on the gross amount from the customer. Whatever gross amount that you receive from the customer, you have to deduct TDS at 1%. When you require to deduct the TDS? At the time of credit or at the time of payment to the e-com operator, whichever is earlier. Now, who should be the payee? It can be a resident e-com participant. That means a person who sells or provides services through e-commerce operator. So listen, I'll display this 194O over here. Say for example, there will be a seller and say Amazon, and there will be a buyer. Okay, this Amazon is actually a digital platform where they facilitate the connection between the seller and the buyer. So the goods of the seller will be sold through Amazon and the customer will buy that particular product. Say customer is paying 10 lakh to the seller through Amazon. The customer is paying 10 lakh through Amazon to the seller. Amazon's commission is say 10%. These are just examples, okay. Amazon will take rupees 1 lakh as their commission and they will pay the remaining 9 lakh to the seller. This is how normally the transaction is. Now listen, Amazon is the deductor here. In this case, the e-commerce operator is who? Amazon. They will be the deductor. And the TDS have to be deducted on what amount? Not on 9 lakh. It is on 10 lakh, on the gross amount. So on the 10 lakh, Amazon is supposed to deduct TDS at what rate? At 1%. This 10%, I have written commission, okay. So on that entire 10 lakh, Amazon have to deduct at 1%. And how much is 1% on 10 lakh? It is 10,000. It is normally like this. Are you with me? Now, what if the buyer, they bought some goods through Amazon, but they are making the payment directly to the seller? In eBay and all, it is possible. In Amazon, it is not possible. You have to make the payment through Amazon only. In Flipkart, is also the same. But in eBay, it is possible. You can directly make the payment to the seller also. That is also possible in eBay. So if you are making direct payment to the seller, that payment also shall be deemed to be made through the e-commerce operator. This is what the department says. Are you with me? So this is the note. Any payment made by the customer directly to the e-commerce participant for the sale of goods or provision of services made through e-commerce operator shall be deemed to be amount credited or paid by the e-commerce operator to the e-commerce participant and shall be included in the gross amount for the purpose of TDS. So if you are making a payment through the Amazon or if you are directly making the payment to the seller, both shall be considered as deemed to be payment made through Amazon only. Now let's go back to the question and understand what is the scenario in the question. So listen, who is the seller in this question? XY and Co is the seller. Who is Amazon in this question? ABC is Amazon. That means the e-commerce platform. Who is the buyer in this question? They are not saying any name of the buyer. Some buyer. Okay. Mr. Whatever it is. There is a buyer also. Now listen. What they have done. See, ABC Limited credited in the books of accounts and with a sum of 4,90,000 for the sale of online products are made to XYZ and Co. Out of the above sales made during the February, Mr. Rai, who purchases the products through R, through the digital facility of ABC Limited, made a payment of 60,000 directly to XY and Co. So total value was 6,90,000. Out of 6,90,000, 60,000 paid by the customer directly to the seller. So what to do? Nothing. On that entire 4,90,000, you need to deduct tax at 1%. And what is the value? It will be 4,900 will be the value that have to be deducted by the e-commerce operator in that respective case. Are you with me? Are you all with me? So that's it. So the total sum in the books of accounts is 4,90,000. Out of that 4,90,000, 4,30,000 directly given and 4,30,000 given through e-commerce operator and 60 directly given by the buyer to the seller. Both have to be considered for the purpose of deducting 194.0. So now let's go to the answer. As per 194.0, ABC Limited e-commerce operator is required to deduct TDS at 1% on 4,90,000 being gross amount of sale of products of R of XY and Co. partnership firm of an e-commerce participant since the sale of goods is facilitated by ABC Limited through its digital facility. ABC Limited is also required to deduct tax on the payment of 60,000 directly made by XY and Co. since such payment is deemed to be amount credited to the XYZ. Thus, ABC Limited is required to deduct, that is 4,900, that is 1% of 4,90,000. So gross amount of sale is 490, out of which 430 was paid to e-commerce operator and the balance 60,000 directly paid to XY and Co. partnership firm by one of the buyers. So hence you have to deduct TDS on the entire value. This is how you have to write the answer. If you write like this, you will get 2 marks. This is actually an easy question only. Yes or no? Direct question only. There is nothing special in this question. That's it. Now, let's solve question number 8. That is related to transfer pricing. transfer pricing. This question is related to transfer pricing. You need to check 94A, that is notified jurisdictional area plus arithmetical mean while computing arm's length price. So you need to go through these two concepts before solving the question. So please pause it and go through both the concepts. Thereafter we will solve it together. Okay. Question number 8. So what is question number 8? Yalin Limited is located in country X, that is a notified jurisdictional area. Amro Limited, a domestic company, the assessee, sold goods to Yalin Limited on 15 January 2024 for 11.75 crores. Now, during the current financial year, Amro Limited sold identical goods to KB Incorporate as Edinburgh, UK for 13 crore. KB Incorporate is neither situated in any NJ nor is associated person of Amro. While sales to KB Incorporate were of CAF basis and the sale to Yalin Limited was on FOB basis, which paid ocean freight and insurance amounting to 25 lakhs on purchases from Amro Limited. India has a double taxation avoidance agreement with the UK, and assessee has a policy of providing after sales support service to the tune of 19 lakh to all customers except Yalin Limited, which procured the same locally at a cost of 23 lakh. Whether Yalin Limited and Amro Limited are associated enterprise? If yes, compute arm's length price for sales made to Yalin Limited and the amount of consequent adjustment, if any, in the profits of Amro Limited and the assessee company for assessment year 24-25. Explain with reasons. First of all, the question is very clear. They are saying that assessee Yalin Limited in country X located in NJ, and our assessee is Amro Limited, which is a domestic company in India. So a person who is in India is actually dealing with a person who is in a notified jurisdictional area. What is the speciality if you are dealing with a person in NJ? Let's go to the theory. Okay. And related theory under NJA, which is under transfer pricing, and let's understand what exactly is the theory. So you go to page number 1 second. It is page number 97. You go to page number 97 in our handbook. You can see the explanation for notified jurisdictional area. So, what do you mean by notified jurisdictional area? Due to the lack of information exchange mechanism, central government will declare certain jurisdictions as what? Notified jurisdictional area. And if any person in India is dealing with another person who is located in this notified jurisdictional area, then there are certain consequences. That's what we are about to discuss right now. So, consequences. Number 1, if assessee enters into any transaction with a person in NJA, then such transaction shall be deemed to be an international transaction with associated entity, and all the TP rules will get invoked, and the benefit of permissible variation between ALP transfer price would not be available in respect of such transaction. The first blow over here. Now let's come back to the question and draw a chart based on the facts in the question. So in the question, Yalin will call it as Y Limited, which is in NJA. And our assessee is Amro, that is A Limited in India. A Limited in India, that is a domestic company, sold goods to Yalin Limited. That means a person located in NJ. Now the first consequences, this shall be deemed to be an international transaction with associated entity. This shall be deemed to be an international transaction with associated entity, and all the transfer pricing provisions shall be fully applicable over here. So all TP provisions will be applicable. That simply means the price which is reported by Amro in this question is how much? 11.75 crore is the price reported by Amro. Now, you have to check whether it is at arm's length price. This is the first thing. So, for checking the arm's length price, Amro Limited have sold similar goods, okay, identical goods to another company, KB Incorporate. KB Incorporate of Edinburgh, UK. And this sales was at what rate? At 13 crore. The sales happened at 13 crore rupees. KB Incorporated is neither situated in any NJ nor is associated person. So, this is an independent party. Now, while sales to KB Incorporated are CIF. So, KB Incorporated, this is CIF. What is CIF? Cost including insurance and freight. What is FOB? Free on board. Free on board means the cost excluding insurance and freight. Alright. Now, sales to Yalin Limited was on FOB. So, this sales price is FOB and the other one, this is CIF. So, this 13 crore contains insurance and freight. You need to remove it. This method that we are about to follow is CUP method. Identical product we are identifying and we are making that identifying or identical transaction comparable with the reported transaction. Are you with me? It is called as CUP method, comparable uncontrolled price method. So, see, while sales to KB that we have already said, CIF, sales to Yalin is on FOB, which paid ocean freight and insurance amounting to 25 lakhs on purchases from Amro, and India has a double taxation avoidance agreement with UK. Oh, they are simply saying double taxation avoidance agreement at all. So, the assessee has a policy of providing after-sales support service to the tune of 19 lakh to all customers except Yalin, but procured the same locally at a cost of 23 lakh. Now listen. So, here the insurance and freight is how much? They have given, amounting to 25 lakhs. That is number one. Now, there is one more adjustment. Assessee, that means Amro, has a policy of providing after-sales support service to the tune of 19 lakh to all customers except Yalin. That means here it is with the warranty. This is with warranty. So, you listen, if Amro is providing warranty to KB, then this 13 crore contains a provision for warranty also. That's how we determine the cost. How do you determine the sales price? All the cost plus decide margin. That is the sales price. Yes or no? So, normal formula for determining sales is cost plus margin will give you the sales price. Cost includes warranty cost also. So, if Amro is providing warranty to KB, so this 13 crore contains the warranty cost as well. And on the other case, there is no warranty because they are not providing any warranty. So, two adjustments are there. Number one for the freight and insurance. Number two for the warranty. You need to remove that warranty cost to arrive at to make it comparable. Now, in relation to the warranty, 19 lakh for all customers except Yalin, which procured the same locally at 23 lakhs. So, Yalin procured this warranty locally at 23 lakhs. Now, what you need to do? Let's compute the arm's length price by applying CUP method. CUP method we have to follow here. So, CUP method, what all are the steps to compute the arm's length price? Number one, identify independent transaction. Or we will move on to the theory book, handbook, so that you will get a better clarity over the methods of determining ALP. The first method is CUP method, and you can see the CUP method over here. It's in page number 84 in our handbook. If you check page number 84 in our handbook, you can see the CUP method, comparable uncontrolled price method, that is called as CUP. Now, identify the price charged for any comparable uncontrolled transaction between unrelated party. That simply means independent price. In this question, which is the independent price? That 13 crore is the independent price. Yes or no? Now, not yet over. Adjust the above price on account of differences which could materially affect the price in the open market. There are two adjustments, one for freight and insurance. You tell me, in this 13 crore, there is influence of freight and insurance, which is not there with the transaction with AE. So what you need to do, from 13 crore, you need to deduct that 25 lakhs to make it comparable, because the 13 crore including freight and insurance. So we are removing freight and insurance, and how much is that? 25 lakhs. Are you all with me? Not yet over. This contains warranty as well. Warranty as well. Ambro Limited is providing warranty to all the customers, and the associated cost they are saying is 19 lakh. Associated cost for providing warranty is how much, friends? 19 lakh. So if you deduct that also, how much will be the comparable price? So you deduct this 25 and 19 lakh. How much will be the comparable price, friends? 12 crore 56 lakhs will be your comparable price. Yes or no? Array, yes or no? Great. So 12 crore 56 lakhs will be your comparable price. Now there is another thing. There is a thing called arithmetical mean concept. In arithmetical mean concept, if your comparable is less than or equal to 6, that means if your comparable, number of comparable you have is less than or equal to 6. Here we have only one comparable. And department say it is sales, right? So this is the arm's length price computed as per the method. And what is the reported price? 11 crore 75 lakh is the reported price. Yes or no? Reported price is 11 crore 75 lakh. You can have a variation of plus or minus 3%. You can normally have a variation of plus or minus 3%. Yes. So there is always a permissible deviation of plus or minus 3% when it comes to arithmetical mean concept. Now, how much is 12 crore 56 lakhs minus 3%? Can you tell me how much is? Come again? 12 crore 18 lakh 32,000. So here, if the person who's sitting in NJ, then department say you will not get the permissible deviation of 3%. If the person, you're dealing with a person who's sitting in NJ, you're not supposed to get the benefit of that permissible deviation of plus or minus 3%. That's why in the theory of NJA, we have written like this. Yeah, you can see a thing like this. And the benefit of permissible variation between ALP and transfer price plus or minus 3% would not be available in respect of such transaction. So here you don't have to do any plus or minus 3%, but you have to write the note. The permissible variation of plus or minus 3% is not allowable since the person is sitting in notified jurisdictional area. Now you tell me, friends, the reported price is 1175, arm's length price is 1256. How much is the profit to be increased? Profit to be increased. Tell me, because your sales value is only 11 crore 75. The ALP according to our computation is 12 lakh 56. How much is the profit to be increased? 81 lakh have to be increased. The profit to be increased should be 81 lakh. You tell me, it is an easy question or not? It's a very easy question. You are getting 6 marks for this. Okay, it's nothing. It's only an easy question. You will get 6 marks if you write this much, and it is a fantastic question also. Alright friends, so let's continue our discussion. That is question number 9. That's what we have to discuss right now. Okay, so since it is a theory question, let's read it together and find out the answer. Answer the following. Your answer should cover issue involved, provision applicable, analysis and conclusion. Okay, so now let's read the paragraph. Assessee had taken an engine on lease under an agreement with a foreign company, lessor, a tax resident of Germany having no permanent establishment in India. The foreign company also does not have PAN in India. So assessee has taken an engine on lease under a lease agreement. So friends, let's understand. So we will write assessee. He have taken a lease under a lease agreement with a foreign company. There is a foreign company. He is the owner of that particular asset. So assessee took a property on lease. Now assessee have to pay him what? Lease rentals. Alright. Now what are they saying? This person is from Germany. This person is basically from Germany, having no, and this person does not have any PE in India. No PE in India. Then, what is next? The foreign company also does not have PAN. This person also have PAN in India, does not have PAN in India. The assessee company deducted the tax at 10%. So, assessee company deducted TDS at 10% on this. As per the provisions contained under DTAA between India and Germany. This rate he got from DTAA between India and Germany. According to the DTAA rate of rental, lease rental shall be at 10%. Okay, assume that it is 10%. It is not an assumption, that's what the question says. However, revenue contended that in the absence of furnishing PAN, assessee was under an obligation to deduct tax at a higher rate of 20%. So, hope you remember, there is a section called 206AA in income tax. What this section says is, if the payee is not furnishing his PAN, or if the payee is not giving his PAN to the deductor, then the deductor is supposed to deduct TDS at what rate? At 20% rate, or a rate which is higher than that which is mentioned in the act. Okay, now the problem is, in the light of the latest Supreme Court ruling, discuss whether contention of revenue is correct or not. So, there is a Supreme Court case law which is cited in the year 2023. So, based on that, the department is saying you to find out the answer. Let's understand what exactly is that particular scenario. So, please listen. The case in relation to this is Air India Limited 2023 cited by the Supreme Court. A similar case happened in India, that is Air India Limited 2023 Supreme Court. Now, what exactly is the debate here? According to the department, since the payee does not have PAN in India, the rate of TDS should be under 206AA, it should be at 20%. This is what the department says. Okay. Now, what is the contention of assessee? Assessee says we have deducted TDS according to the DTAA and the rate shall be full and final at 10%. Here 206AA will not be applicable because the foreign company does not have any PE in India and is not required to apply for PAN as well. So, which is right? Let's understand. See, hope you have studied under the DTAA there is a thing. An assessee can always opt for the beneficial provisions either in Income Tax Act or DTAA. That simply means every assessee can either opt for the beneficial provisions of DTAA or IT Act. If a particular provision is more beneficial for you, if a particular provision in DTAA is more beneficial for you, then you don't have to follow IT Act. Vice versa also. If you think that IT Act is more beneficial for you, then you don't have to follow DTAA. This is what the common parlance under section 90 is all about. So here, assessee says TDS at 10% is beneficial for the foreign company. Okay, the foreign company will definitely go for the DTAA rate at 10%. Now, the Supreme Court here directed that, or Supreme Court observed that this section 90 subsection 2, that means this beneficial provision thing will override all the provisions in Income Tax Act. That means in such a case, no, even though the payee does not have a PAN, you don't have to deduct TDS at 20%. This was the original judgment given by the Supreme Court in the case of Air India Limited. Now, let's go through that particular answer, how to present that particular answer. So, listen, in such a question, they clearly mentioned that you have to note down the issue involved, provision applicable, analysis and conclusion. So, there should be 4 paragraphs or there should be at least 3 paragraphs. Issue, provision, analysis and conclusion, or it's better to write in 4 paragraphs. First one, issue involved. What is the issue? The issue under consideration is whether the provisions of section 206AA which prescribe a higher rate of TDS in case of non-furnishing of PAN by a foreign company override the double taxation avoidance agreement that specify a lower rate of tax. So, the debate here is which is better, 206AA or section 90 subsection 2, which prevails, which will override. That is the discussion or debate happened in this particular case. Now, what are the provisions applicable? As per section 206AA, in the case of non-furnishing of PAN by the deductee to the deductor, tax is required to be deducted at higher rate specified in the relevant provisions of the Act that enforce or the rate of 20%. And what is the analysis? Analysis and conclusion. Section 90 subsection 2 provides that the provisions of DTAA would override the provisions of the Act in cases where the provisions of DTAA are more beneficial to the assessee. The provisions of DTAA will override the provisions of the Act if the provisions of DTAA are more beneficial to the assessee. Even the charging sections under 4 and 5 of the Act, which deals with the principle of ascertainment of total income under the Act, are also subordinate to the principle enriched in section 90 subsection 2. That simply means even the charging section 4 and 5, that also will be overridden by what? DTAA provisions. That simply means a particular income is taxable according to the domestic law. It is exempted according to the DTAA. Then also you don't need to pay any taxes for that particular income, even though section 5 scope of total income provides for taxing. DTAA section 90 subsection 2 will override everything. Are you with me? Now, thus, insofar as the applicability of scope or rate of taxation with respect to the impute payment made to the non-residents in concern, is no fault can be found with the rate of taxation invoked by the assessee based on DTAAs, which is prescribed for a beneficial rate of taxation. And hence, Supreme Court says that here the assessee, the deductor, have deducted TDS only at 10%. This cannot be a violation because he complied to the beneficial provisions of the DTAA only. Now the provisions of withholding. Withholding means TDS. Tax withholding means TDS. That is section 195 of the Act would apply only to the sums that are otherwise chargeable to tax under the Act. The provisions of DTAA along with section 4, 5, 9, 90 and 91 of the Act are relevant while applying the provisions of tax reduction at source. Therefore, section 206AA of the Act cannot be understood to override the charging sections of 4 and 5 of the Act. So, you cannot say that 206AA will override the other provisions in Income Tax Act. Accordingly, the contention of revenue means department, that in the absence of furnishing PAN, the assessee was under an obligation to deduct tax at source at 20% is not correct. So, the contention of department is not right. And as a note, the facts given in this question are similar to the facts in CIT, International Taxation versus Air India Limited, 2023, 454 ITR 139 Supreme Court. The above answer is based on the rationale of the Supreme Court ruling in the said case. I hope it is clear. So, the debate happened in this case is whether 206AA or 90 subsection 2, which we have more power, 90 subsection 2 only, because according to 90 subsection 2, any assessee in India have the option to choose between the beneficial provisions of DTAA and Income Tax Act. And hence we can say that deducting tax in this case at 10% is perfectly fine. Even though the payee does not have PAN, 206AA will not come into the picture because the DTAA only says that you deducted 10% and that is full and final. I hope that is clear for you. So let's move on to the next question. That is question number 10. Okay. What is question number 10? Answer the following. Your answer should cover issue involved, provision applicable, analysis and conclusion. Similar question. Okay. So issue involved, provision applicable, analysis and conclusion you have to write. So let's understand what exactly is that particular case. So friends, please listen. So let's understand the question. The assessing officer passed an assessment order under 143 subsection 3, that is regular assessment. Regular assessment on 20/11/2018, in which the assessee committed the mistake of reducing depreciation in computation of income instead of adding to the income, resulting in double deduction of depreciation. So what happened is, in which assessee committed the mistake of reducing the depreciation in computation of income instead of adding to the income, resulting in double deduction of depreciation. So there was some mistake, and due to that there is kind of a double deduction for depreciation. AO did not correct the said mistake in the order. So AO haven't noticed it. So AO haven't corrected that particular mistake. Now the assessee went up in appeal on other issues to CITA. So the order, we can write it like this. There was an order of assessment. Just like this, there was an order of assessment, and in the assessment order or in the particular return, there was an issue. Say this is the return, okay, this is the return of income, and in the return there was one mistake, that is double deduction for depreciation. This return was subjected to regular assessment. This return was actually subjected to what? Regular assessment, which is under 143 subsection 3. Regular assessment. And what happened? Assessing officer did not notice that. Okay, assessing officer did not notice that particular issue, and the assessment got over with some other issues. We can say other issues. This other issues, assessee filed an appeal. For this other issues, assessee filed an appeal with Commission of Income Tax Appeals. So there is a return, there is a regular assessment order, and there is an appeal filed. Now, coming back to the particular question, who decided the appeal on 28/6/2023? So the regular assessment came on 20/11/2018. Regular assessment date was 20/11/2018. And when was the appeal decided? The date of decision of appeal is on 26th June 2023, 28th June. So this came on 28th June 2023. This is what they are saying. The AO gave effect to the CITA's order, white order dated 27 July 2023. So the AO considered, the CITA decided something and the AO accepted that, and he was about to make that adjustment in the order of assessment. The AO thereafter passed an order under 154 dated 26/4/2024. So AO after this passed the rectification order. Rectification order, which is under section 154. And the date of rectification order, when is the date of rectification order? They have given it in the question. They are saying 26th April 2024. The assessing officer passed the rectification order based on decision of CITA. Decision of CITA. Now, based on the decision of CITA, now what happened? In which he rectified the mistake of double deduction of depreciation and committed in the order dated 20/11/2018. What he have did? See, when he issued a rectification order on 28th April 2024, what he have done? In the original return, there was a mistake. In the original return, there was a double deduction for depreciation. That mistake have to be spotted in the regular assessment. But unfortunately, assessing officer did notice that particular mistake. So what happened? This mistake was unrectified in the regular assessment order. So thereafter, an appeal has been given by the assessee, and the appeal got decided on 28th June 2023. Based on that appeal, CITA told AO to rectify certain mistakes. While rectifying those mistakes as a part of appeal, AO find out that double deduction of depreciation and he rectified that also. Okay, now what is the problem now? Please discuss whether the time limit of 4 years as per section 154 subsection 7 would apply from the date of original assessment order or date of appellate authority. Let's understand. See, for this you should know what is 154 rectification. Let's understand what is this 154 rectification. Let's see what exactly is this rectification of mistakes. Okay, so 154 rectification of mistakes. IT authority can rectify the mistake in the following orders. If you have any mistakes in the following order, the IT authority have the right to rectify it. Which all are the orders? Out of that, number 1, any order passed by the IT authority that includes a regular assessment order. That includes a regular assessment order passed by AO. So as you all know, the return there was a mistake committed by the assessee. The assessing officer is bound to identify that particular mistake and they have to rectify that mistake in the regular assessment order itself. So we can say, while passing the regular assessment order, AO have committed a mistake. Now AO can rectify it under 154. Yes or no? While passing the regular assessment order, AO have committed a mistake because he haven't noticed the double deduction of depreciation. So he should have to rectify it. Now, the rectification happens under 154. But there is a problem. What is the problem? The time limit is the problem. You can see the note number 6. The time limit of rectification within 4 years from the end of the financial year in which the order sought to be amended was passed. So, which is the order that you are about to amend? From that order's financial year's end, you have to count another 4 years. That is the maximum time for rectification. Once application is filed by the assessee within the above timeline, the authority should pass the rectification order within 6 months. The rectification can be done either suo motu or on an application made by the assessee. So this is a suo motu rectification case. Now listen. Now the debate here is, as you all know, the time limit for rectification is 4 years. Here we have two orders. Number one, order of appeal. There is order of appeal is there. Number two, regular assessment order is there. So the debate here is whether 4 years have to be counted from this date or this date. That is the issue here. Are you with me? Normally the 4 years have to be counted from the end of the financial year in which the order so to be revised is issued. Okay, so end of financial year in which order so to be revised is issued. Now the problem here is whether this time frame of 4 years have to be taken from this date or this date. Let's understand what exactly is that particular judgment, or what exactly is that particular scenario, not judgment, scenario. So the issue involved, what is the issue involved? The issue under consideration is whether the time limit of 4 years as per 154 subsection 7 would apply from the date of original assessment order or a date of appellate authority. Whether you have to start counting from the original date of assessment order or date of order of appellate authority. That is the debate. Now, what are the provisions? As per section 154 subsection 7, no amendment under 154 shall be made after expiry of 4 years from the end of the financial year in which the order so to be amended was passed. That we have already said. What is analysis and conclusion? Once an appeal against the order passed by the authority is preferred and is decided by the appellate authority, the order of assessing officer merges with the order of appellate authority. If a regular assessment is subjected to an appeal, then the appellate's authority's order will get merged with the assessing officer's order. That's what this sentence is. Are you with me? Let's read that once more. Once an appeal against order passed by authority is preferred and is decided by the appellate authority. Appellate authority means CITA. The order of AO merges with the order of appellate authority. That means the AO's order will get substituted by the appellate authority's order. After merger, the order of original authority ceases to exist and the orders of appellate authority prevails. So after appeal, there is no regular assessment order. It's all about the CITA's order. The final order passed by the appellate authority was dated on 28th June 2023 and acting thereupon the AO passed their assessment order giving appeal effect to 23 July 2023. Thus, in order passed by CITA, which remains on record for all intent and purpose as the order of assessment has been merged. Once the matter is viewed in this angle, it does not matter whether the error which is sought to be rectified occurred in the original was calculation error, which could not have been subject matter of appeal. Thus, the period of limitation of 4 years for the purpose of 154(7) has to be counted from the date of order of appellate authority. So, you can definitely consider the date of order of appellate authority itself. Note the facts given in the question are similar to the facts in Tony Electronics Limited, and the above answer is based on the rationale of Delhi High Court ruling in the said case. So, what happened here is, listen, once matter is viewed from this angle, it does not matter the error which is sought to be rectified occurred in the original was a calculation error which could not have been subject matter of appeal. Okay. Thus, the period of limitation of 4 years have to be counted from the date of order of appellate authority. So, I hope you got an idea on what happened. So, you tell me from which day you have to start counting. You can start counting from this day onwards. 28/6/2023. That means end of this financial year. End of this financial year. This financial year is 2023-24. End of financial year means 31st March 2024. 4 years from that particular date means 31st March 2028 you have typed. So, they have rectified it in 24 itself. So, it is valid in the act. Valid as per the law. I hope it is clear. Are you all with me? See, in this question, series of events happened. Okay, assessee filed a return first. That is the first thing. Assessee filed a return. In the return, there was a mistake, and a regular assessment order came in on 20/11/2018. That regular assessment order, there was an appeal happened, and the appeal decided on 28th June 2023. Based on that appeal, AO rectified the mistakes, and that rectification order came on 26/4/2024. And the debate is that 4 years for rectification, whether it have to be start counting from the date of regular assessment order or date of order of appeal. According to the Tony Electronics Industries, it can be counted from the date of order of appeal. Why? Because once appeal came in after regular assessment, the regular assessment order will get merged with the appellate authority's order. So there is no regular assessment order afterwards. It's all about the appellate authority's order. Now you can start rectify that from the date of order of appellate authority. That is the conclusion in this question. I hope it is clear right now. So we will discuss the next question. I want all of you to go through the next question. That is question number 11. Question number 11. The ICAI also comes with an alternate answer. Okay, there is actually an alternate answer for this particular case or particular situation which were discussed earlier. Okay, what is the alternate answer? I will discuss that alternate answer also with you. Okay, listen. But in exam, you have to write only one. You don't have to write both the alternatives. There is an alternate answer. Since the concept of partial merger is applicable in section 154, the rationale of Supreme Court ruling in the case of Alagendran Finance Limited or Industrial Development Bank of India Limited 2023, which is in relation to 263, can be applied in the present case. Accordingly, the analysis and conclusion alternatively would be as follows. So there are two other case laws which is not connected with 154, but it is connected with 263. Okay, so they are giving an alternate answer based on some other case laws also. Once an appeal is against the order passed by the authority is preferred and is decided by the appellate authority, the order of assessing officer merges with the order of appellate authority but limited to subject matter of appeal. In the present case, the final order passed by the appellate authority dated 28/6/2023 was on other issues. Thus, the period of limitation of 4 years for the purpose of 154 subsection 7 has to be counted from the date of original order of assessing officer on matters other than matters decided by the appellate authority. So, what is the alternate answer? We'll see the alternate answer. Listen. See, alternate answer is a little bit more complicated. Listen. Say this is the regular assessment order. In the regular assessment order, they have never dealt with what? The double deduction of depreciation. They have missed that particular double deduction of depreciation. So there were some other issues. Okay, in the regular assessment, there were some other issues. Only on this other issue, the assessee have gone for an appeal. Assessee have gone for an appeal on this other issue. If the assessee have been filed appeal for other issues, then normally the appellate authority will decide only on the other issues. Then the appellate authority will decide only on the other issues. We don't know which all are the issues covered by the appellate authority in this question because they are not mentioning the issues that they are covered. Are you with me? Now. If it is like this, then the CITA's order does not have anything related to the double deduction of depreciation. Yes or no? Now, if the CIT's order have something related to the double deduction of depreciation, then only you have to start counting from the date of issue of order of CITA. In all other cases, you have to start counting from the date of issue of order of assessment. So that's what they are saying as an alternate view. If CITA refers something about the double deduction of depreciation, then it is fine. AO can rectify it within 4 years from the end of the financial year in which CITA's order came into effect. If the CITA is not mentioning anything in relation to the double deduction of depreciation, then 4 years have to be counted from the end of the financial year in which the date of order of assessment came in. So in this question, we don't know whether CITA is referring something in relation to double deduction. So we can write an alternate answer also. We are assuming that CATA is not at all dealing anything in relation to the double deduction of depreciation, and hence you can start counting from the regular assessment order. But you have to write the reason also. That reasoning is more important. Either you stick on to the totally electronics and you say it get merged. So you have to start counting from the date of order of CATA. Or you can say we don't know what exactly are the matters dealt by the CATA, and we are assuming that the CATA has referred nothing in relation to double deduction of depreciation, and hence you can start counting the date from the regular assessment order date itself. Both are fine. Alternate answers are there. In exam you have to write only one view. Are you all with me? So now go through question number 11. Go through question number 11 and give me the answer. What are they saying? Question number 11. That is, answer the following. Your answer should cover again issue involved, provision applicable, analysis and conclusion. Let's see. ABC Private Limited, a domestic company, is engaged in software development business at Technopark, which is employed 700 employees, deducted tax at source in respect of salary, contract payment, etc., totaling to 1 crore 10 lakh up to 31st March 2024. So, you have deducted TDS up to 1.10 crore up to 31st March 2024. That means 23-24 they have deducted TDS for assessment year 24-25. In March 2024, the assessee deposited a part of the TDS being 38 lakhs. Out of this, only 38 lakhs they remitted. Only 38 lakhs they have remitted on March, till March. The balance 72 lakhs was deposited later in July 24. Okay. In July 2024, they have remitted the balance. So we can say there is actually what? A delay in depositing the TDS. Are you all with me? Now, so there is a delay in depositing the TDS. However, the additional commissioner of income tax issued a show cause notice proposing to levy penalty under section 271C of Income Tax Act 1961 of an amount equal to the TDS, and also levied penal interest under section 201 subsection 1A of the Income Tax Act 1961. So due to this late deposit of TDS, what department did is like, department asked for a interest and they initiated the penalty proceedings as well under section 271C. Are you with me? Now we should understand what exactly is 271C. Then only you will be able to answer this particular question. So this question is not related to TDS chapter. This is related to penalties chapter. Are you with me? So let's understand what exactly is this 271C. You can jump to page number 308 in our handbook. Under 308, there is 271C has been given. This is the one. Failure to deduct or pay or ensure payment of tax at source under 194B, that is tax on casual income, TDS on perquisite, TDS on virtual digital assets, TDS on winnings from online games. So if you fail to deduct or pay or ensure payment of tax, okay, ensure payment of tax means, say for example, casual income, winnings will be in kind. Then you cannot deduct the TDS. Then you have to tell the winner that you have to deposit 30% of the winning amount. Then only we will release the assets. Are you all with me? Say I'm conducting a program. My winning is 1 crore worth flat. Big boss winning is 1 crore worth flat. We cannot deduct 30% TDS from flat. Okay, why? Because it is in kind. So you have to tell the winner that you have to deposit 30 lakhs money. Then only we will release the assets. This is what is called as to pay or ensure payment of tax. Are you with me? Now, so how much is the penalty, friends? A sum equal to amount of tax which was failed to deduct or pay, or we can say collect. Okay, pay or collect we can say, levied by JC. And if you show reasonable cause, then definitely there won't be any penalty. That is what 273B is about. There is a reasonable genuine cause for the failure to deduct TDS or failure to ensure payment, then you can definitely go out of the penal proceedings. Now, here what happened is, assessee have deducted TDS and he paid up to 38 lakh and there was a slight delay. Okay, there was a slight delay in paying the 72 lakhs TDS. Due to that slight delay, department want to invoke penalty as well as interest. Okay, now listen. Are you able to follow what I am saying? So let's understand what is the remaining thing. Feeling aggrieved and dissatisfied with the levy of interest and penalty under section Income Tax Act 1961, on the late deposit of TDS, the company had approached you to seek your opinion, seek your advice in the matter. So the company have approached you. You might be a chartered accountant or a cost accountant, whatever it is. You are a tax expert. Okay. Now the company approached you and they are asking what is the solution. We are not happy with this. Now you tell me. 276C is very clear. Either there is a failure to deduct or pay or ensure payment of tax at source. Okay. There will be what? Penalty. If there is a default in deducting TDS, or if there is a default in collecting or ensuring collection, then there will be what? Penalty. Now, here the assessee have correctly deducted all the TDS and he have correctly made all the payment. But it is right that there is a slight delay in depositing the TDS. Now, can they ask for penalty and interest? One thing is very clear, they can obviously ask for interest. There is no exception from interest. But whether department can ask for penalty, that is the question. Let's see what exactly is the answer. Have you understood the context? Now let's see the answer. Listen, issue involved. This issue under consideration is whether penalty under section 271C and interest under 2011A both are leviable on the late deposit of TDS. So the TDS has been deposited and there is a delay. A penalty will obviously come. Interest will obviously come. The penalty, whether it will come or not, that's what we are about to discuss. Provisions applicable. Section 271C, subsection 1 clause A, provides that if any person fails to deduct the whole or part of tax required by or under the provisions of chapter 17B, that is TDS, then such person is liable to pay by way of penalty a sum equal to the amount of tax which such person fails to deduct. So if there is a failure to deduct TDS, then how much is the penalty? That equivalent amount, 100% of the TDS that you fail to deduct shall be the penalty. Section 2011A provides that in case tax has been deducted at source and it is subsequently remitted belatedly, such a person is liable to pay interest as provided under section 2011A. That means if there is either a failure or there is a belated payment, you have to mandatorily pay interest. And how much is the percentage? 1.5% for delay in depositing the TDS. Analysis and conclusion. On plain reading of 271C1A, no penalty would be leviable on belated remittance of TDS after it is deducted by the assessee. So this case is non-deduction case. This is not a non-deduction case. They have deducted and paid, but there is only a delay. For the delay, can department charge penalty? The answer is a big no. They cannot. Similarly, section 276B speaks about prosecution for failure to pay the tax deducted at source to the credit of central government within the prescribed time. The words fail to deduct in section 271C cannot be read as fail to deposit or pay the tax deducted. If there is a failure to deduct TDS, definitely department can definitely levy penalty from the assessee. There is a delay in depositing TDS, that is not a triggering point for invoking penalty. Now, accordingly, no penalty would be leviable under 271C on delay in remittance of tax deducted at source after deducting it on time. However, interest under 2011A for late deposit of TDS is leviable. Interest under 2011A is definitely leviable, but penalty is not leviable. This actually is a case. It's an old case. Not an old case. It cited in 2023. That is US Technologies International Private Limited versus CIT, wherein the issue came up before the Supreme Court. The above answer is based on the rationale of Supreme Court in the said case. So it is based on a Supreme Court case which is cited in the year 2023, US Technologies International Private Limited. I hope that is also clear. So what is the conclusion? If there is a delay in paying TDS, you cannot levy any penalty. If there is a default in deducting TDS, yes. If the casual income or the person who conducts the program, if he failed to collect the TDS, yes, they can definitely levy penalty. There is a delay in depositing the TDS, cannot be a triggering point for levying penalty. That's what the case law is all about. The Supreme Court judgment is all about. Are you all here? I hope it is clear for you. All good. So moving on to the next question, friends. Question number 12. Let's go to question number 12. Let's not waste time on question number 12 because it's a direct theory question. Okay, we'll read the question, read the answer, and we'll move on. Okay, it's question number 12 is a direct question, direct theory question. So we will read the question and read the answer. Now, question 12. Explain the term exchange of information as per Article 26 of Model Tax Convention under OECD model and UN model, and explain the importance of Article 26. Which chapter it is related to? Overview of tax treaties. Article number 26. They are asking you to what do you say? Explain the point in relation to article number 26. So can you just read the question? I hope you have read the question. Let's read the answer. In order to complete tax cases, a country may require certain information which may be available with treaty partner. That means India wants to complete an assessment of an assessee. We don't have adequate information in relation to that assessee because that assessee have a lot of income in a foreign country. We want that particular information. So we have a DTAA with that foreign country. We can ask for what? Information in relation to our assessee from that foreign country by making use of treaty under clause number 26, that is exchange of information, or not clause number, article number 26, exchange of information. Article 26 provides for information which may be exchanged and in the manner in which such request has to be made. How to exchange the information is given in Article 26. OECD and UN model conventions are similar with respect to this article. Both OECD model and UN model convention. Article 26 is about exchange of information and they work similarly. Importance of Article 26. Facilitates effective exchange of information between contracting states. That means contracting countries. Contracting states in DTAA means countries. Number 2, curtails cross-border tax evasion and avoidance. It will actually helps to reduce the cross-border tax evasion and avoidance. Then curtails the capital flight that is often accomplished through tax evasion and avoidance. This is particularly relevant in perspective of developing countries. So if you are transferring capital without getting taxed, that information also the other country can provide us. So exchange of information clause is all about to help a jurisdiction to complete the tax assessment. If you write this much, you will get how much marks? 4 marks. Okay, it's a direct theory question. What is Article 26? Explain about what? Exchange of information clause. I hope it is clear for you. Great. Moving on to question number 13. Question number 13 is related to your last chapter in ICA study material. That is, what do you understand by globe rules? Okay, that is actually the latest development in international taxes. That is the chapter. Which entities are covered under these rules? Let's understand what is this globe rule and what are the entities covered under these rules. It's a 2-mark question only. Okay, so direct theory question again. So pillar 2 consists of globe rules, which means global anti-base erosion rules. Globe means global anti-base erosion rule. Though which 15% of the globe minimum tax has been introduced. The globe rules apply to constituent entities that are members of MNE. So globe rules are applicable to constituent entities of an MNE. What is MNE? Multinational entity groups, constituent entity that has annual revenue of euro 750 million or more in the consolidated financial statement of ultimate parent entity in at least 2 of the 4 fiscal years immediately preceding the tested fiscal year. So this is just like a direct theory and you can write the answer like this. You will get 2 marks. This is a direct theory from your last chapter in ICA study material, that is latest development in international taxes. Next question is an interesting question. That is from tax audit chapter. Okay, it's an interesting question. So I want all of you, even though it's a direct theory question, you should read and understand what is the circumstance. So I want all of you to go through this particular question. That is question number 14. It's from tax audit. So go through this particular question and try to give me the answer. It's a 4-mark question, 6-mark question from tax audit. So go read and give me the answer. Okay friends, so let's solve that question as well. It is related to your tax audit chapter, okay? So listen, what are they saying? Club View Travel Private Limited engaged in the business of travel agency remitted substantial amount to Australia as per their information collected by income tax department from PTU bank. So your assessee is a club. Okay, he remitted certain amounts to a travel agency in Australia, okay, through a bank. So income tax department collected the information from the bank. The department collected documents from the bank which include form 15 CB issued by the chartered accountant and the list of passengers, copy of their passports, date of travel, invoices raised by the foreign party, etc. So in that particular scenario, what they have done is they have collected, the department have collected from the bank 15 CB, that is the chartered accountant certificate. Okay, when you are transferring some remitting, that is remittances outside, foreign outside remittances. Okay, so you are remitting some amount outside, the client themselves have to issue 15 CA, and if the amount is more than 5 lakh, then they have to get it certified by a chartered accountant, which is called as 15 CB, overseas remittances we will call. Now, so the next point is they have collected all the information. On inquiry from the passengers and verifying their passports, it is found that they did not travel abroad on the dates mentioned in the document. So, Club U Travel Private Limited transferred some amount to travel agents. On further investigation by the department understood that there was no such travel happened. Okay, and the chartered accountant had certified in 15 CB also. We have gone through everything. This travel have happened and these are the amounts. We have verified this. This is the main purpose of 15 CB. Now, on the top of its passengers also denied that there was no transaction with Club U Travels Private Limited. So, department went to another level. They directly approached the passengers. And the passenger, they themselves are saying that we haven't conducted any travel. These amounts are some fake transfers. So, income tax department concluded that the amount were remitted by the company on the basis of false invoices and for wrong reasons. So, they understood that these are based on false invoices and wrong information. It led to FEMA violations. So, this is some other amount. This outside remittance is some other amount. They called it as for overseas travel and all. Now, the form 15 CB issued by the chartered accountant was a vital document in this transaction because the bank has transferred the amount based on form 15 CB issued by the chartered accountant. Okay. During 6 months period in question, the chartered accountant has issued 78 certificates in form 15 CB involving remittance of around 35 crores for Club U Travels Private Limited. So, it is not about the case of one single certificate. He have issued how many certificates? 78 certificates. That too having a total amount of up to 35 crore of foreign remittances. Now, a representation was given by concerned chartered accountant that he was issued form 15 CB based on invoices produced by the company and verifying the KYC documents of signatory to the invoices. So, what the chartered accountant said, he completely relied on the representation given by the assessee and he verified the KYC documents of the signatory and the invoices. This contention was that since he was not statutory auditor of the company, he did not examine the books of accounts before issuing form number 15 CB or conduct due diligence of business activity. So, what chartered accountant say? He is not the statutory auditor. So, he simply relied on the invoices and the KYC information and the representation given by the client. He haven't done any further due diligence. He charged 2,500 per certificate. So, he charged only a small amount of 2,500. Mostly the fees were collected in cash. That means it is not a fake certificate because he charged only the nominal amount. But the question is, have he done his duty properly? He is not a party to this particular false transaction. That is right because he charged only 2,500 rupees for a certificate. That is a common fees only. But the question here is, have the chartered accountant done his duty properly? Is there any misconduct? Some part of the fees were credited in the bank account also. Can the chartered accountant be guilty of his professional misconduct for the failure to obtain sufficient information and failure to exercise due diligence in discharging the professional responsibility? Straight away I can tell you the answer. Yes. He is responsible for professional misconduct. Why? Because he simply relied on the invoices, simply relied on the management representation rather than. So friends, now because he haven't relied on the, he simply relied on the documents given by, he haven't done any further investigation. So let's go to the answer. Let's understand how to write such, how to answer such questions in exam. Okay. So form number 15 CB is a certificate of an accountant wherein he certifies that he has examined the agreement between the remitter and the beneficiary requiring such remittance, and he has examined also the relevant documents and books of accounts required for ascertaining the nature of remittance and for determining the rate of deduction of tax at source. Now, the chartered accountant certifying form 15 CB undertakes to have verified the agreement between the remitter and the beneficiary as well as relevant documents and books of accounts to ascertain the nature of remittance and determine the rate of TDS. So whenever you certify 15 CB, the thing that you are doing is you are saying that you have verified the agreement, verified the books of accounts, verified the relevant documents. So you are saying that I have gone through everything and I am certifying that such a transaction happened, and this is an original transfer, not based on any fake invoice. This is what the level of accuracy that you should have when you certify a form 15 CB. Now, in this case, however, chartered accountant mentioned that they had only verified KYC of the signatory to the invoice and the invoices thereof. So the chartered accountant have only verified whether it is signed by an original person, and he simply relied on the invoice. He haven't checked the authenticity of the invoice. Whether the invoice is original or fake, he haven't checked. He haven't verified the agreement. He haven't verified the books of accounts. He had not only failed to justify as how the verification of invoices was considered, he haven't verified the invoices at all. He simply relied on the invoice as sufficient compliance for certifying the forms, but also failed to bring on record the said invoices. Thus, he failed to provide any basis on which he relied for the issuing 15 CB certificates to the company. So that 15 CB issue is not proper because he failed to verify the authenticity of the invoices and he haven't verified the books as well as agreements. On account of such failure, he is guilty of professional misconduct as per clause 7 and 8 of part 1 of second schedule to the Chartered Accountants Act 1949 for failure to exercise the due diligence in discharging his professional responsibilities, and failure to obtain sufficient information may be invoked. And failure to obtain sufficient information may be invoked, you can cross off. Okay. So here the chartered accountant is definitely guilty for his professional misconduct because he haven't verified that particular documents in a proper manner. I hope you got my point. Are you with me? And there is one more thing, friends. This is actually one of the case studies in the ICA study material. There are certain case studies given in the ICA study material. This is one of the case studies given in the ICA study. It is a copy paste of the case study. It is actually a copy paste of the case studies given at the back of ICA study material. It's not a new question. So please go through that particular other case studies as well. Moving on to question number 15. So I want all of you to go through this question number 15. Please go through question number 15 and give me the answer, friends. So friends, let's understand what exactly is the question. Specify with reasons whether the following acts can be considered as tax planning, tax management, tax evasion. First of all, what is tax planning? Tax planning simply means, say, claiming ATC deduction is a tax planning. Claiming rebate under 87A is a tax planning. Okay, giving donations is a tax planning. Are you with me? Or taking a loan for your house is a tax planning because both the interest and principal you can claim as a deduction. And what is tax management? Filing return, filing forms, filing relief forms, etc. can be called as tax management. Compliances, you are doing all the compliances and that is called as tax management. What is tax evasion? You are not showing the profit that is required to be disclosed. Is said to be what? Tax evasion. So we will move on to the theory. So you can take page number 274 in our handbook. That is tax planning, tax evasion, tax avoidance and tax management. Let's see. Tax planning, an arrangement of one's financial affair in such a way that without violating any way the legal provision, full advantage is taken of all tax exemption, deduction, concessions, rebates, allowances and other reliefs or benefits permitted under the Act, so that the burden of taxation on the assessee is reduced to the minimum. Claiming 6-year reduction is one of the examples for tax planning. Tax evasion. Tax evasion refers to any attempt to avoid payment of taxes by using illegal means. That means you are not disclosing your income or claiming fake expenses, etc. is called as what? Tax evasion. Misrepresentation or suppression of facts, failure to record investments in the books of accounts, claim of expenditure not substantiated by any evidence, etc. is called as what? Tax evasion. Now, what is tax avoidance? Tax avoidance is an exercise by which the assessee legally takes advantages with maleficent motive of loopholes in the act. That means tax avoidance means you are finding out the loopholes and you are restructuring your transaction in a way that you are taking advantage of the loopholes in the act. Advantage is maleficent motive of loopholes in the act. The tax avoidance is minimalizing the incident of tax by adjusting the affairs in such a manner that although it is within the four corners of law, it is done with the purpose to defraud the revenue. It is a practice of bending the law without breaking it. So you are bending it without breaking it. For example, 48(2), you are giving excessive payments to your relatives. That is one of the methods for tax avoidance. Okay. Then tax management. It is procedure to comply with the provisions of the law. It is continuous approach and it is concerned with the past. Rectification, revision, filing return, filing form, corrective action, etc. is said to be what? Tax management. Timely filing of return, tedious return, etc. can be called as an example for tax management. Now let's move on to the theory. Now the examiner wants you to identify whether the item number 1 and 2 is either planning, management or evasion. They are not talking about avoidance. So you are supposed to say either it is planning or management or evasion. That is your duty. Let's see. Number 1. Mr. D has an FDR with SBI in his name amounting to 50 lakhs. So Mr. D has some FD. He gifted the sum of 50 lakhs to his son on 10/4/2023 and the date of which he attained 18 years of age. So son is a major son. So he have gifted that entire 50 lakhs to his major son. That is perfectly permissible in the act. If he is a minor son, then he would have been subjected to clubbing provisions. Okay. If he is a major son, then absolutely no problem. It's perfectly permissible. He transferred that particular asset. Now, the purpose is to shift interest income from his hands to his son's hands. So he wants to give this gift to his son. And there is one more problem. If it is a revocable transfer also, it is not permissible. What is revocable transfer? It is not actually transferred to the son. For the time being, I am showing as my son as the owner of the deposit. Thereafter, in future, I have a power to reclaim back that particular deposit. That is also not permissible. When they say simply transfer, it is not a revocable transfer. Now, the purpose is to shift the interest income from his hands to his son so that there may be zero tax implication since his son has no other income and the total interest would be lower than the taxable limits for previous year 23-24. You tell me it is tax planning, management or evasion. Anyways, it is not management. It is not evasion also. Why? Because you are not illegally or misrepresenting anything. You have legally transferred the ownership of FD to your son's name to take out the advantage of what? Basic exemption limit. It is only a tax planning. It is considered as what? Tax planning. But. If it is a revocable transfer, then it would have become a tax avoidance. Okay, if it is a revocable transfer, it would have become a tax avoidance and it is subjected to clubbing provisions. Here, the son is a major one and you are transferring it forever because the question is not saying that it is a revocable transfer. So let's see the answer. They are saying that it is a tax planning only because gifting of fixed deposit of 50 lakh by Mr. D to his son who attained the age of 18 years for the purpose of shifting interest income from his hands to his son so that there may be zero tax implication is permitted tax planning measure under the provisions of income tax law. There's a note. It has been assumed that such transfer is irrevocable and Mr. D does not derive any direct or indirect benefit from such income. If Mr. D is taking the interest of FDR, then it would have become a tax avoidance. Okay. In case transfer of fixed deposit is irrevocable, then interest income on FD would be included in the income of Mr. D and hence the same would not be considered as tax planning. It would have been considered as tax avoidance in such case. Are you all with me? Got it. Moving on. Point number 2. Can you read point number 2? I hope you have read it. Mr. Ram's annual income is 49.50 lakhs for assessment year 24-25. Excluding commission receivable from ABC Limited. During March 2024, he earned a commission of 6 lakh from ABC Limited. So he got another commission of 6 lakh. He asked ABC Limited to transfer the commission in his wife's account. So he is not accepting the commission in his name. He told the company to transfer the commission in his wife's account, who's a housewife. He also asked them to deduct TDS in the wife's name. So the TDS deduction is also he is recommending to do it in the wife's name. He did it so that his total income may not cross 50 lakhs. If the total income crosses 50 lakhs, then he is supposed to pay surcharge. He can save surcharge on the taxes applicable on total income exceeding 50 lakhs. His wife has no other income. So you tell me, is it tax management? No. Is it tax planning? No. It is tax evasion, because you have illegally, it's your income. Okay, it's a kind of an illegality is there. You are showing it in the name of wife. Wife have no such skill to earn a commission. It's your income. You are showing it in the name of your wife. So it is tax evasion only. Mr. Ram's annual income is 49.50 lakhs for assessment year 24-25. He also earned a commission of 6 lakhs from ABC Limited. Accordingly, his total income would be 55.50, which exceeds 50 lakh, and hence the surcharge is applicable on the total income. So he evaded that surcharge element. Okay. However, for the purpose of saving tax, he instructed ABC Limited to transfer the commission in his wife's account. This is a case of application of income and not diversion of income by overriding title, since such transfer is commission not under any obligation but to evade the taxes, and this is tax evasion only, and you will be penalized for your action if it is tax evasion. I hope it is clear. These are actually simple things only. You are getting a mark of how much if you write this to? Again, 4 marks. Okay. Moving on to the next one. That is the last question in May 2024 question paper. So can you go through question number 16? This is in connection with BAR, Board for Advanced Rulings. We call it as BAR. Okay. Not the other bar. It is Board for Advanced Rulings. Okay. So let's read the question. Listen. A non-resident foreign company entered into contracts with several Indian companies for installation of mobile telephone system and made an application to the Board of Advanced Rulings for advanced rulings in relation to the tax liability arising out of such transaction. So you are a non-resident foreign company. So you were doing something and you have given an application to Board for Advanced Rulings. Application to what? Board for Advanced Rulings. Now, one of the above said Indian company also made an application to the assessing officer for a determination of question of law with regard to payment made to the said foreign company. That means this foreign company is doing some services in India. Okay. That means some Indian companies are the other parties. The Indian companies are supposed to give some payments to the foreign company. This Indian company have already given, this Indian company what they have done is, on the above said Indian company made an application to the assessing officer for a determination of question of law with regard to the payment made to the said foreign company. So this Indian company have already given an application to AO. Okay. So AO is considered as an income tax authority, and this application is already given to understand about TDS consequences in relation to the same transaction. Okay, so listen. Say there is an Indian company, they are about to make some payment to a foreign company. The Indian company have given an application to the assessing officer to know the TDS liability of the transaction. TDS liability means income tax liability of that particular transaction. And the assessee, NR foreign company, who is the recipient, also have given, are about to give an application to BAR to determine the tax liability. So both the applications purpose is same. Are you with me? NR want to know their tax liability. Indian company want to know their TDS liability. The purpose of both the application is one and same only. Now listen. Now what happened? The Board for Advanced Rulings rejected the application of the foreign company on the ground that the question raised is pending before income tax authority. Is the rejection of application of the foreign company justified in law? Because the BAR says that already a similar petition is pending before income tax authority. With the assessing officer, already a similar petition is there. So why are you coming again with the similar petition in front of us? So they rejected that particular petition. Rejected the petition. Now let's go to the relevant theory. So please take the chapter Board for Advance Rulings. You can take page number 125. Okay. Page number 125. Board for Advance Rulings, chapter, section 245, procedure on receipt of application. If the board is getting an application, what should be the procedure? Under that, BAR, what is BAR? Board for Advance Rulings, will always reject application if the assessee, if the question raised is pending before it at CITA, except will apply in case of public sector company, except CG notified persons. Involves determination of fair market value of any property, is for avoidance of income tax. So listen, according to the act, what they are saying is, if you are giving a petition, to board for advance rulings, and the petition is related to a matter which is pending before income tax authority, any income tax authority, okay. Actually, in the act, it is any income tax authority. We have clearly written ITAT or CITA, or we can say any income tax authority. Then that application have to be rejected. But in this case, assessee is the non-resident foreign company. They haven't given any application to any income tax authority. The other party have given an application to an income tax authority, that is assessing officer. So there also bar rejected the application. Is this rejection valid or invalid? Because NR or foreign company haven't given any, if the NR or foreign company have given an application to the AO, then definitely they can reject it. Here the NR haven't given any application to AO. The other party have given an application to AO. The NR have given an application to BAR. So is it valid or invalid? Let's see the answer. Again, it's a theory question. Let's see the answer. Application for advance rulings. As per section 245, the board for advance rulings, after examining the application and records called, may either allow or reject the application. However, the board shall not allow the application where the question raised in the application is already pending before income tax authority or appellate tribunal or any court. However, bar shall not allow the application only if the question raised is already pending in the applicant's case before income tax authority. Accordingly, based on this view, rejection of application by the bar is not justified in law, since the question raised in the application made by the foreign company is pending before AO in case of one of the Indian company and not in the applicant's case. Only the Indian company have given a petition to the AO, not the foreign company assessee, and hence they cannot reject the application based on pending petition. Are you with me? Alternative views are also possible, but this is the best view that you can take. Are you all here? Here the assessee, that is the foreign company, haven't given any petition to bar. Hence, bar cannot reject by stating that the application is pending. The same issue is there, but not given by the assessee. Hence, it is perfectly within the law. They are not supposed to reject the application. This is what we can say. And what is the question number? It is question number 16. And what is the mark? 4 marks. By that, I can say May 24 descriptive question analysis is completely over. I hope you understood all the questions and its answers.